Association of Chartered Accountants in Mumbai, having around 10,000 CAs members, and they organize all good quality programs and conduct good number of in well-formatted teamwork. As leading association of Calcutta, we have long been association with BCAS, and our senior and active members have always been participating in the BCAS RRCs. In fact, to my information, Calcutta members' presence is second after Mumbai in last few RRCs. We have also been organizing half-day seminars with BCAs since last 1 decade, and in fact, this year also we had fixed a program on 18th of April in a meeting at Tirupati in January, but the conference could not be held due to COVID. The lecture meeting was planned like a normal virtual session, but I am glad that both the president of BCAS and Narayanji has joined the meeting, and I am thankful to them for their joining today. With these words, I now request our study circle convener, Sri Sanjay Poddar, who incidentally is also a committee member on BCAS from Calcutta, to introduce all the dignitaries and speakers from BCAS and take the session forward. Thank you all.
Thank you, President. We welcome, I Sanjay Poddar on behalf of DTPA as a convener, I welcome BCAS President and past President Mr. Narayan Pansari also. The present President Suhas Sivaram Pranjape is a chartered accountant. He became the President in the current year 2020-21. He is become from ML Dhanukar College, Vile Parle, and C of and he is LLB and DISA. At present, he is part-time in Bhoran Associates since 1995. He is a proprietor of Suhas Pranjape Company, having office at Jawahar Nagar. His nature of practice audit taxation with a focus on indirect tax, company law service, society, and advisory services. He also faculty at Willinger Management Institute for full-time and part-time courses during the period 2010 to 2014. With this, I request Sri Suhas Bhai to please give some valuable thoughts about BCAS and about ourselves. Suhas Bhai. Suhas ji.
Yes, thank you, Sanjay Bhai.
Thank you.
Respected Narayanji, Chairman BCAS MRD Committee, Shyamji, Agarwalji, Narendraji, Sanjayji, Rajeshji, and my dear participants of DTPA, and my two young speakers, Vishesh and Kinjal. So I will try to speak in Bengali, which I have learned. So please accept it with a person from Maharashtra. I would say Namaskar and good afternoon, Bandhugon. Common Ache, Bhalo Tao, it means how are you, all well. I hope I am to some extent I am right. So my friends, let me brief you about BCAS as a president for the year 2021. Sanjayji and others are regular people who attend our programs, etc. So they are surely aware about BCAS. However, there will be people who are not aware. So let me just introduce BCAS. It is an ethical and governance driven quality conscious institute with 9,000 plus members all over, and there are many people from Calcutta who are our members. One more characteristics of BCAS is whatever we do with long-term vision. Let me explain what I mean. BCAS itself is 72 years of existence, and it is moving towards 75 years in next 3 years. So for any voluntary organization, 72 years is too a long time to continue, and with the quality which we are trying to maintain. BCAS Referencer, one of the very important and signature publications. It has completed, it is now in its 58th year. Presently, publication is available for sale. I was told that Calcutta people have already got the copies of it, and they have already purchased some additional copies. That is what Narayanji had told me. Thank you very much for the same. If you require anything more, please let us know. It is available for sale presently. BCA Journal. the mouthpiece of BCA, a monthly journal, BCAJ, is 52 years completed, and it is one of the most important and the most respected publications of our professional body. And when I say 52 years, it is continuous 52 years without a single break. That is what it means. It's a monthly journal without single break. When I say referencer, it is 58 years without a break. So everything is without break. BCS RRC, the residential refresher course, is has completed 53 years, and our ITF has completed 24 years. It will be next year, it will be entering into 25th year of International Finance Conference, ITF. And our RSC, the GST RSC refresher course, has completed 14 years. So these are all milestone events, these are all signature events, these are all signature publications which are continued and there for long term, year after years, and gives value to all our members. I'm sure many people from Calcutta are subscribing. They are regular people who attend to our RRCs, etc. And I know them personally also. This year we are on virtual. However, I have met them personally many times. All this long-term and long-lasting scenario could happen mainly because of two reasons. The power of BCAS platform, that is one, a very solid platform BCAS gives to its members, and its dedicated and committed volunteers. Today it is exactly 5 months of national lockdown, and BCAS has portrayed its capability to change and became much more relevant today due to the digital. And let me tell you, this team of chairmen, team of past president, and team of technology savvy youth force of BCAS, it is a positively deadly combination. Let me repeat, it's a positively deadly combination, and it will take BCAS to a new heights. I'm very sure about it. We realize in last 5 months that digital events and the contents provide absolute focus, discipline, and systematically structured contents. You also must have realized all that this is that people become much more disciplined when they are on virtual mode. As a president, I invite the non-members who are present here to join this BCAS platform and experience personally what I said to you. And this year our theme is transition to transformation. So with the help of digital, we want to reach to more and more people, to more and more members, and one of the ways of doing it is to join hands with regional organizations like DTPA and other organizations. And I'm sure this year we should take maximum opportunities to do the joint programs and reach to more and more members. So I invite organizations like DTPA to join hands with us and do more and more virtual programs. I will close my brief with again Bengali words that susto thaken, bhalo thaken. It means stay healthy and stay safe. Please take care of yourself. I thank you all for giving me this opportunity to communicate with you. Thank you very much.
Thank you, Suhas bhai. Thank you very much for your lovely Bengali words. We will really appreciate those words and will keep in our memory. With this, I request Sri Narayan Basari ji. He is actively associated with Bombay Chartered Accountant Society for past more than 2 decades and has served the 69th president during 2017-18. And he has been inducted as a president in the presence of Union Minister C.A. Piyush Goyal. Since 2018-19, he is the chairman of Seminar Public Relations and Membership Development Committee of BCS. This year, 2021, he is the 3rd consecutive year. I am also a member of this committee. Just wanted to inform you in BCS. C. Narayan Basari qualified as chartered accountant in 1986. During his more than 3-decade-long professional career, he has acquired wide range of experience in audit, corporate governance, risk advisory, merger acquisition, corporate advisory, and business re-engineering. He is adapting, developing, and maintaining sustained business relationships with India's top C-suite executives. He has been the founder of both his college and school alumni association and is actively involved in giving back to alma maters. Sri Narayan Prasad is a commerce graduate from Mumbai University. He is an alumni of the prestigious Narsi Munji College of Commerce and Economics and the St. James High School. Currently, he is a peer reviewer and with the peer review board, also the reviewer with the Financial Review Reporting Board of ICAI. He is a senior member of the study group for revision of Practitioner Guide to Audit of a Small Entity released by ACI in February 2020. In 2018, he was nominated the SNDT Women University for a period of 5 years as a nominee of Honorable Governor of Maharashtra to oversee and guide various activities related to finance, budgeting, audit, and fee taxation. He is also a passionate follow Indian economy, Indian politics, Indian cricket, and Indian Bollywoods. With these words, I request Narayan Bhai to say a few words.
Thank you, Sanjay ji, for the introduction. And I will not stay behind my president. So I again start with Namaskar, Kolkata. পৃথিবী সুস্থ হয়ে উঠুক এবং আপনারা সবাই ভালো থাকুন এই আশা নিয়ে আমি আমার বক্তৃতা শুরু করতে চলেছি This means Namaskar Kolkata. I hope the world heals and all of you are keeping well. With this hope, I am starting my speech. President of DTPA CA Narendraji Goyal, my president CA Suhas Paranjpe, my today's youth speakers from BCA, young friends Vishesh and Kinjal, other dignitaries from DTPA study circle, Sri Shyamji Agarwal and Sri Rajeshji Agarwal, convener of this virtual study meeting, CA Sanjayji Podar and a very dear friend of mine, seniors in the profession and my professional friends on Zoom. Good evening to each one of you. I can see 152 people already in the seminar, in the webinar. On behalf of BCAS, my president and my Yuva speakers, I extend our greetings to each one of you and wish and hope all are safe and secure in these present times. As chairman of the seminar, Public Relations and Membership Development Committee of BCAS, I am delighted to be present amongst all of you for today's virtual study circle meeting where BCAS is honored to be the knowledge partner. Kolkata has a very special place in my heart. I mentioned this to Sanjay ji a lot of times. Right from my childhood, I have visited this city of joy a number of times as I have many relatives both on my paternal and my maternal side staying here. Together with my cousins, uncles and aunts, I have explored so many attractions this city has to offer, including Victoria, the Howrah Bridge, the Fort Williams, the Belur Mutt, the Indian Museum, among others. Listening to Rabindra Sangeet and going pandal hopping during Pujo are some of the memories I still cherish. And how can I forget tucking in those platefuls of rasagullas, sandosh, chomchom, and the tangy jhalmuri. To further cement my ties with the city, my younger son's fiancée is from this cultural rich city. In the last few years, I have also built a special rapport personally with many members of DTPA who are also members of BCA and are regulars at many of our residential courses. This bonding has resulted in the BCAs and DTPA organizing many events with the city of Kolkata playing host to many speakers from the BCAs fold. This time too, we are here again, albeit virtually, which is the norm in the current scenario thanks to technology. Now some insights into BCA and what it stands for. In its 71 years of existence, BCA has always aimed to disseminate knowledge, promote professional excellence and well-being. BCA is the acknowledged leader with regard to the quality and finesse of its programs. We continue to raise the bar with each passing year, even during these times of lockdown. These restrictions has made it incumbent upon the BCAs to provide our members and followers a safe and effective means of learning and professional development through many lecture meetings, webinars, residential refresher courses, long-term duration courses, talk shows, all. The seminar committee is committed to organize many programs, even during the present work from home environment. As my president mentioned, our referencer team of which Kinjal is the youngest editor, beat the lockdown and came up with the ebook version released in June last month, and during the last month released the print version as well. This year is the 50th year of the continuous publication of this prestigious publication. We have already sold more than 2,000 copies, and I'm happy to state that DTPA Kolkata made a block booking of 70 copies, courtesy the efforts of Sanjay Ji Podar, who I am proud to share has been inducted into my committee this year. As part of public relations initiative, the committee in the recent past jointly organized 2 huge webinar meetings on the subject of MSME with other professional and trade associations from Pune and Chennai. Both were a grand success and has further cemented the reputation of BCA as a sought after knowledge partner with many professional associates in other cities. To cap it, a music video of Corona Ko Harana Hai was released in July. The entire video, including the lyrics, commentary, composition, audio recording, videography, mixing, editing, and voiceover, was made in-house by the super talented past presidents, office bearers, and BCA members. The YouTube hits has crossed 2,000 mark recently, and the video is gaining popularity with each passing day. And now, my big but humble appeal to all chartered accountants who have logged in today. As per BCA's records, we have only 150 members from Kolkata, which is a minuscule percentage of our 9,000 plus membership all over India. Kolkata and the eastern region, according to my estimate, is home to 60,000 plus CAs. I earnestly appeal to all who are still not members of the BCAs to come into our fold. Please reach out to members like Sanjay ji, Nilima ji, Narendra ji, Rajesh ji, and others to understand for yourself the benefits of becoming a member of the BCAs. As members, you will benefit from our prestigious journal, which is in the 51st year of publication. Our president just mentioned that. We organize a host of lot of programs. We also are very active on the social media forums too. With this pandemic and its restrictions likely to continue for a fairly extended time, many programs will be conducted online so that our members and professional colleagues can take benefit of these from the comfort and safety of their homes and our offices. Please visit our website www.bcsonline.org for more details. Application form for membership and payment details are available on our website. I also appeal to those who are already members in Calcutta to become our brand ambassadors and promote BCAs. After all, the ambassador car was once the beauty and pride of your city. I will be failing if I don't share some thoughts on this one-time pandemic. The rapid measures effectively taken by the government of our country for containing the spread of the virus has been praised all over the globe. Both the UN and the WHO have called India's response to the pandemic as comprehensive and robust, and termed the lockdown restrictions as aggressive but vital for containing the spread and building necessary healthcare infrastructure. This has really paid dividends in the last 5 months. The government has helped and enabled its citizens to be well prepared to face the challenges and threats posed by the virus. All COVID warriors are so motivated that they are ready to risk their lives without hesitation. The kind of morale our countrymen have displayed in this period is remarkable. The size of the problem we as a country face is huge, and equally strong antidotes will be needed to see it through this pandemic. Looking ahead, stimulus to kickstart industry in terms of manufacturing as well as consumption is a step to be considered to begin a positive consumption manufacturing employment cycle. I am confident that the government will consider this as the next step forward, a more inclusive as well as stable economy. Chartered accountants as a profession has over the last 7 decades played a vital role in the nation building process, and especially given the challenges that the economy is going through today. They are committed to rebuild a strong and vibrant India. Extra efforts would have to be put in by each one of us in this direction. And now about education and learning, a small paragraph. It is said that an ignited mind is the most powerful weapon on the earth, above the earth and under the earth. And this is got through education. Education is the most profitable investment for the future. It is said that learning never stops at any age, and so true for chartered accountants. I once again congratulate the DTPA CA Study Circle for organizing this meeting, which covers the current topic of the season, and express our gratitude and pleasure to be a knowledge partner. We commit to remain connected, virtually or otherwise, in a special professional bond, and would be delighted to hold such seminars in the future as well. Friends, we all need to understand that the only way to protect ourselves is to keep practicing social distancing, personal hygiene, and repetitive sanitization as a lifestyle. BCA also endorses and supports these activities to ensure a healthier environment for all of us. Till then, stay safe, stay secure. Happy learning, and over to you, Sanjay ji. And thank you for the occasion and the chance given to me to speak to the DTPA members.
Thank you, Narayan bhai. Thank you, Narayan, for your valuable words and guidance about the going to happen in future. With this, I request our Deputy Convener Girdhar Dheliaji to present. And nowadays, it's not possible to give the original bouquet. We have tried to provide you the. This is to the President of BCS. Suhas bhai, please accept it. Now this bouquet to Narayan bhai.
Thank you, sir. Thank you.
Thank you. Okay, Girdharji, thank you very much. With this, I request our, before we go to the speaker, I request our Directors Committee Chairman, Sri Paraji Kochar, to say a few words. Paraji, please share your valuable thoughts.
Please, Shyam, please unmute him.
I've unmuted him. Parasji?
Haji.
Yes, sir.
Am I audible?
Yes, sir.
Yes, sir. Please give
Audible.
your initial remarks on the subject.
Friends, it is a matter of great pleasure for me in chairing this session. We have two learned speakers with us, Mr. Vishesh Sangoi and Kinjal Bhuta, who are from Mumbai. Both speakers will spread their knowledge with us on today's topic. Changes in income tax returns and other related changes. You all are aware that certain changes have been made in income tax return, and some of changes made in income tax returns are complicated. So expert advice is needed. Apart from changes in returns, the learned speakers will also speak on changes made in Form 26AS and requirement of efficient reporting of special financing transactions. Due to COVID-19, it has been very difficult for the professional to furnish return of income with extended due date, particularly in certain cities, including Kolkata. Since income tax act is amended every year and rules are also changed every year, returns are also changed, and hence everywhere you have to know the changes about returns. In due course, return will become paper book of the SSC containing most of accounts and important information of the SSC. Before furnishing return of income, we should check it twice so that there should be no error. The number of scrutiny cases will be minimal, as most of the returns will be automatically scrutinized due to vast details filled up with the returns and information contained in 26AS. There will be automatic cross verifications. More transactions will now be reported in 26AS. The scope of 26AS will be further enlarged. The SSC will have to be cautious for householding drawings or household drawings. Our clients do not show full personal expenses in accounts. Since now purchase of white goods, certain traveling expenses will also be reported. The client should account for every household expenses in books of accounts. Friends, this is time to change our mindset as well as mindset of the SSCs to adjust with change scenario. We will see a lot of further changes in coming days. The learned speakers will now enlighten us with their vast knowledge. Over to Sanjay ji.
Thank you, Paraji. Thank you very much. Now we're moving on to the speakers introduction. CA Kinjal Bhuta. She is the founder of Kinjal Bhuta and Company. Her area of practice and specializations are direct tax litigation, advisory, and transfer pricing. She is CA LLB become qualified, and she has working experience of 10 years, more than 10 years in the field of direct tax and international taxes. She worked previously in KPMG Taxation and Messrs. AJ Shah and Company Chartered Accountant, heading their direct tax litigation and transfer price practice. She is managing committee member at BCS, and she is a co-editor of BCS Referencer, as Narayan bhai said earlier. She is the author of book on presumptive taxes under section 40AD, 40ADA, and 44AE. She is core group committee member of direct taxation seminar and membership development and human resources and development committee of Bombay Chartered Accountants Society BCS. CA's contribution of various articles to tax journal like BCAS, Chamber of Tax Consultants, AFTP, etc. She is a regular speaker at various WIRC study circle of ICI, and she happens to be the convener of Seminar Public Relation and Membership Development Committee, of which I am also a member. Our second speaker for today is Vishesh Sangoi. Vishesh Sangoi is the direct tax partner at DPS and Company Chartered Accountant. His area of functional expertise including members, transfer pricing, regulation and area regulation. After qualifying as a member of ICI in 2030, he has worked with CNK and SEOs for 3 years, and he has experience in handling matters related to direct tax in both advisory and litigation domain. He has been involved in advising various corporate, PSU, private equity fund, law fund, charitable institutions. He also been advising client in search and seizure proceeding. He has co-authored the BCS publication on sample from TCD and has been regularly contributing to BCS referencer and BCS budget publication. Presently, BCS is the convener of the Taxation Committee of BCS and member of Study Circle Committee of CBO CA Association. He has been a member of the Directors Committee of Western Indian Regional Council also. With this, I request our Deputy Convener Gidaji to present them a bouquet. Gidaji, this is bouquet to Kinjal.
Thank you.
And this is to Vishesh.
Thank you, Sanjay ji.
Thank you.
लॉकडाउन खुल जाएगा तब एक्चुअली भेज देना संजय जी. I'm really happy that we are 175 people. I did not expect this much. A big applause for all the people who are joined this. A big applause. This shows the power of the youth actually.
Yeah, of course. Great. First session will be taken by Kinjal, CA Kinjal Bhuta, and subsequently Vishesh is going to take the second session. With this, I request Kinjal Bhuta to take up the proceeding. Kinjal ji, you can start now.
Thank you, Sanjay ji, for such kind introduction. I will be talking on the amendments and some other changes in the return, which are incidental to changes in the return forms. We'll also speak on 26 AS changes and other reporting requirements. Whereas Vishesh will take the practical end of it, which is income tax return form changes, which will be a line-to-line changes to the forms. So we can share the presentation.
Kinjal, just a minute, Kinjal. One humble request, please, everybody, please keep mute except the speaker, so that everybody can listen properly. Thank you all. Please continue.
Yes. I'll just share my presentation. Yeah, is it there on the screen, everyone? Yeah.
Yes, it is visible.
Okay, so okay, so as I mentioned, these are the brief contents of what we are covering up today. We will be covering the 26 AS changes and certain changes which has come up because of the unfortunate COVID situation. Along with that, we take some of the important amendments of both the Finance Acts of 2019 and few amendments which were also made in Finance Act 2020, but they are applicable for this year's return forms, which is assessment year 2021. We'll also cover later on the applicability criteria, the changes which they have made, and very specifically the changes in the income tax return forms. And lastly, what all precautions or what all steps we we suggest what can be taken while filing the income tax return forms. So coming to Form 26 AS, unlike earlier wherein I had mentioned it is a tax credit statement, now they have made significant changes from 1st June 2020, and the new Form 26 AS is now called as Annual Information Statement. The notification was number 30 of 2020, and this brought a lot of shift, a lot of change in the reporting which happens in the Form 26 AS. Up till now, we have only the tax TDS and TCS details in the 26 AS. However, now they have expanded the scope and added many other details. Rule 31AB and section 203 AA, these were the legal sections and rules which were guiding the Form 26 AS earlier. Both of them have been now omitted or struck, and now we have a new rule, Rule 114I, and insertion of a new section was made in the Finance Act 285BB. This promulgates what are the changes or what are the additions which are supposed to be done under the new Form 26AS. Again, to clarify, this form or changes are effective from 1st June 2020. So any 26AS downloaded before 1st June will not show these details. However, anything which is downloaded after 1st June will start reporting all the new details as they have listed under the section and the rules. Starting with the part A details or the basic details of the assessee, wherein earlier only the PAN number and the name of the assessee was and the status, whether it is an individual or a company, was reflected. Now they have added another details like Aadhaar number, date of birth, email address, and the mobile number. So these are the details which we provide in our income tax return form and are also updated in the income tax portal. So they'll take all those details from there. One of the another striking feature in the new Form 26AS is that there will be regular updation of Form 26AS every 3 months, 3 months from the end of which the information has been received. So they are going to add all those details which they receive as specified financial transactions from various entities. So 3 months from the end of the month from which they receive those details, they shall start updating it. So it will not be in annual form, it will be in updated version, it will be in live Form 26AS. It also enables a lot of powers to the income tax authorities, wherein they can upload the information which they have received from any other tax officer, any tax department or authorities under any other law also, not restricted to only income tax law. So for example, the details of sale or purchase of properties are reflected, so that they get it collected from other departments, from stamp duty authorities. So that enabling power is also given, and any other action taken under other regulatory authorities can also be reported. So this is as regards to the basic changes which they have made in the procedure of Form 26AS. As as I have mentioned that the TDS, TCS details were already there in the Form 26AS. The additional details which they are calling, one of the most significant change which they have made is all the information related to specified financial transactions. So SFT reporting, which is made by all the entities like banks, financial institutions, mutual funds, stamp duty authorities, or other relevant authorities specified under the section. So all those information which are reported by them to the income tax authorities, those transactions will now form part of Form 26AS. So few examples of specified financial transactions are purchase and sale of property, any work contracts, loans or deposits, any deposit made in saving bank account beyond the prescribed limit, investments or credit card expenditure, foreign expenditure. So all everything has a prescribed amount limit. So based on that, all these information will now also reflect, and it will be there is a specific format in which it comes. So when you all download the new Form 26AS, one may notice the different rows under which they have to report all those details, like under which mode it has been done, whether it is a joint transaction, whether it is a single transaction, when the transaction has been done, the date of the transaction, and the amount. So all these details in a detailed format will be available. Information relating to payments of taxes, whatever taxes, self-assessment tax, advance tax, all those taxes will be there, even any tax on regular assessments, and information relating to payment of refunds. So this was also earlier available, but in some places, some at certain point of time, they used to give the refund details. Sometimes it was not available, but now it is made mandatory to add all the information relating to payment of refunds, and all the pending and completed proceedings under the Income Tax Act. So all the income tax proceedings, whether it may be the regular assessment pending before CIT appeal or ITAT or any other higher authorities, or any other reopening proceedings or search and seizure proceedings. So whatever proceedings under Income Tax Act are pending, and also what are completed. So suppose if there was an assessment for a previous year and that has been settled at the CIT appeal level, so that completed proceedings will also form part of the new form. So it will actually give an entire outlook of all the income tax litigation or income tax proceedings for in respect of that assessee, and any information which is received relating to agreements entered under section 90 and 90A. So this is the treaties and the double tax avoidance agreements which is being entered by India with other countries. So all those information which they receive, even under the information exchange clause, that details they can report under, and they will report under the new form 26AS. So probably all the foreign tax credit details or other credits which are availed under between the two countries, that will form part of form 26AS. So this is also quite a new, it will not only the global tax credit, it is not only the Indian tax credit but also the global tax credit which will now reflect in the new form 26AS. This is as regards to the current situation. Whatever the changes have been made currently and effective from June. However, there are certain transactions which are proposed. So I'll take a minute on what are the proposed transactions. So recently, the Prime Minister, Mr. Modi ji, had come about with a plan for honoring the honest, and as a part of that, they have also made certain significant expansions or additions into the SFT transactions. This is not yet notified. These details we have received only from the official tweet of the Ministry of Finance. However, these are the indicated list of transactions which they may bring about as soon as the same are notified. So why discussing this is relevant is because this will bring a paradigm shift in the entire reporting process. Day by day, or as the time passes, it is very dynamic. The changes are they are expanding the details which they are bringing about. So as we can see that any education fees or donations which are made above 1 lakh per annum, so these are all the transactions which are per annum in that particular financial year. If you have exceeded this limit, then this will get reported. So electricity consumption above 1 lakh, any domestic business class travel or any foreign travel for that matter will also get reported. The ones which are quite important are the regular expenditure which an assessee makes, which is like payment to hotels. The limit for that is 20,000. Mediclaim or the health insurance premium which is paid above 20,000. So an assessee may be paying insurance premium for other family members also. But if that assessee is paying beyond 20,000, then that will get reported. Any life insurance premium above rupees 50,000, and any property taxes. So all the municipal property taxes which is paid on the properties owned by the assessee above 20,000 will also get reflected. Another important disclosure related information which they will bring about is all the share transactions, the demat accounts and the bank lockers which are possessed by the assessee. So as we can see, this will have a huge impact. So 26AS will be nothing but a financial transaction passbook of an assessee, wherein all the transactions, all the income by way of tax credit will be reflected in the new 26AS. And the essence of discussing this at this point of time before we file the return of income is that the reason or the entire focus of them in expanding the form 26AS is to correlate these details with the income tax return forms provided by the assessee. So whether a person is filing the return or not, if the if an assessee has these kind of transactions and still not filing the return of income, they may get into the source of making such expenditure or such a kind of investments. So And the entire idea would be to expand the tax base, as they have been frequently talking about, as the government has been behind expanding the tax base. So these are the initiatives in that way, and one needs to be very careful while filing the return of income to check the 26 AS, to check all the reportings, all the new reportings which are being made in the 26 AS, and as far as possible see that the details which are provided in the return form are aligning with the new form 26 AS. Some may be just disclosure oriented, some may be deductions like mediclaim. So given a case that mediclaim has a dedicated section under section 80D, we will have to give a breakup of what is the mediclaim premium paid for yourself, for senior citizen parents, for your children. So if a person is reporting a huge mediclaim premium in the income tax return form, and the 26 AS form does not report a health insurance premium, even if it is more than 20,000. So, we can see a desync between the two things, and that is where the department will get into. So this is just an illustration, but there can be many such transactions which one may think of, wherein they can try to relate our income tax return form along with the form 26 AS. So our takeaway is that we need to check the form 26 AS carefully, even if there is there may be certain mistakes also in the form 26 AS, because this will be the reporting which is done by those entities under SFT. So they may have some earlier we had certain reporting errors by the deductor of tax at source, and the repercussions were to be borne by the assessee. Similarly, it may happen that there are certain errors which are done by those entities. In that case, one needs to be sure of what are the errors and whether the correct detail has been inserted in the new form 26 AS. So as regards to that, one needs to upload the new form and then verify and then file the income tax returns. As regards to the 26 AS, as we mentioned, what all changes are there. Now, let us talk about the amendments which were brought in the due dates and other exemptions or other deductions which are available in the Act because of COVID situation. So there has been amendment in the due dates of return filing. I think we all are aware of the changes which has been made in the due dates. So there were multiple strings of notifications which they had started right from March, right from when the situation worsened and the lockdown was effective. So the latest notification which mentions the new dates is the notification dated 24th June. This is the latest notification which extends the date of return filing till 30th November. So now the due date for return is streamlined, or it is the same across all the assessees. We earlier at 31st July and 30th October. Now for all assessees, whether tax audit or non-tax audit, the return filing date will continue to be 30th November. And they have also specified in which situations the interest under section 234A will be levied. Interest under section 234A is basically interest on delay in filing return of income. So it is an interest on the essay tax payment which an assessee has to make but has not paid before the due date of return of income. So for that limited purposes of interest under 234A, they have not extended the due date. So when a assessee has a self-assessment tax which is above rupees 1 lakh, this applies only for self-assessment tax above rupees 1 lakh. Below that, there is no change. Above rupees 1 lakh, if you have a self-assessment tax liability, the person has to pay the self-assessment tax before the original due date, which means for non-tax audit assessees, it was 31st July. For other assessees, tax audit assessees, it was 31st October. For transfer pricing cases, it was always 30th November. So for that, there is no change. However, for those assessees where the due date was 31st July and 31st October, and the essay tax increases beyond 1 lakh, that person has to continue to pay the essay tax before 31st July and 31st October to avoid the impact of interest under section 234A. Just to clarify, this is only for interest under section 234A. B and C will apply as it always applies, and the person can very well file the return before 30th November. It is only to avoid the interest impact person has to pay, the assessee has to pay before the original due dates. So one needs to take care to compute the asset tax liability in such cases, and well in advance pay those interest amounts, pays those asset tax amounts. There were another extensions beyond the due dates as well, which is the due date for furnishing the tax audit report. So tax audit report is to be filed normally it is to be filed 1 month prior to the return filing date. So all the tax audits will have to be furnished before 31st October 2020. And the due date for transfer pricing was always 31st October. So there is no change in transfer pricing audits. Due date for all other audit reports under the Act will also be extended. So there are various other audit reports like MAT reports or reports for charitable trust. So all those reports are also extended to 31st October. There was a change which was brought about under section by way of section 12AB, wherein a charitable trust or an institution had to register afresh for the new for the new approval of charitable trust. So that was earlier to be done by 30th September. The provisions were effective from 1st June, and the applications got to be made within 3 months, that is before 30th September. Now that has been extended till 31st December. So a charitable trust or an institution or an entity involved in charitable purposes can make an application up till 31st December. The regular assessments, which were time barring for assessment year 18-19 and September, have now been extended. So that has been extended up till 31st March. And also all the issuance of notices under section 148, which is the reopening matters, that has also been extended till 31st March. So all the assessment procedures have been shifted to March 21. Coming to some other extensions. Just a minute. Yeah. For claiming deductions, so that sorry. Yeah, for claiming deductions under section 54 to 54G, these are the sections which provide deductions from the capital gains income, the long-term capital gains income by way of investments into properties or bonds, etc. So these are the sections pertaining to that. So any deduction which is made under this section, that has also been extended or till 30th September. So a person, if the deadline is approaching between the March, which was the deadline, or till date, then till 30th September that investment can be made, and that investment will be considered for deduction in the income tax calculation. So the person can do any investment up till that. There is a different column which is inserted in the income tax return form. We'll discuss that later, wherein we have to provide such details separately. All the deductions which are made under chapter 6A, which is section 80C, 80D, like life insurance or loan repayments or mediclaim, any donations, these were extended till 31st July. So any investments which were any such investments which were made till 31st July will be available for this year's deduction. Just one thing I would point out, that there may be a situation that an assessee would have invested for the next assessment year also. So suppose I have made a PPF investment on 1st of April for claiming it for the next year. So assessee has an option whether it can claim for assessment year 2021 or assessment year 21-22. If the assessee wants to claim for the current assessment year for which we are having the return forms, then that has to be specified in the ITR form, and it can be claimed obviously just once. So once if, but the option lies to the assessee. So that is because there may be situations where an assessing would have made investments for both the assessment years. So that bifurcation needs to be made. Then there was it was mandatory to link the PAN and Aadhaar card. That date has also been extended till 31st March 21. So in the income tax return forms at various places, the linking was required as per the new section. So that they have deferred. So person may not provide those details. Furnishing of SFT details, which is the financial transactions, which we recently just talked about for financial year 1920, that is also extended to 31st March. So in this case, one needs to notice that this is as regards to assessment year 2021. So when you check your form 26AS, which has to report this SFT transactions, naturally there will be certain transactions which are not forming part of 26AS, probably because those entities have not furnished their SFT returns. So one may wonder that why those details are not reflecting when the investments or when the transactions have already been made. So this could be one of the reason that these transactions are not appearing. Since the deadline has been extended till March 21, the reporting will also obviously be extended in certain entities. Those who have already reported, those details will form part of 26 years. Due date for furnishing TDS returns for for March 20, that was also extended. This was extended till 15 July for all the government deductors and 31st July for all other deductors. So this is the TDS returns, which is the last quarter returns for the financial year 1920. So some of the assessees who have filed some of the deductors who have filed TDS returns late in the sense just towards the extension, that is 31st July or 15th July, the assessees would have right now not received the TDS certificates for them. So since that is because of the extension, so one needs to wait for those TDS certificates probably to file the return of income, or one has to wait so that the details are reflected in form 26AS first, verify that those details are there in 26AS, and then file the return. So the due date for furnishing the TDS certificates also, as I mentioned, is extended or was extended till 15th August. So by 15th August, we should have received, the assessee should have received all the TDS certificates for financial year 1920. Now the form 26L will start updating those details of the quarter end. Just before I move on to amendments, as respect to the changes in the 54 and 54G, I would also request to clarify one thing, that in certain cases like 54 or 54F, when the property investment has been made, suppose the property investment has to be made within 2 years, or it has to be constructed within 3 years from the sale. There is also another criteria wherein the assessee has purchased the property 1 year before the sale transaction. So in some cases, it may happen that the assessee has already purchased the property but could not sell the property within this period, before March, or if the duration was suppose between March to September. So in those cases, also the extension applies, because the ordinance or the notification is clear that the extension applies not only to investments but any other parameters mentioned under those sections. So an assessee still make a sale now and avail deduction of a investment which was made 1 year before. So just that clarification. Coming to the amendments, so I covered some of the amendments or the major amendments which are impacting the income tax return forms or impacting the return of income which the person has to report for assessment year 2021. So coming to the basic tax rates, as regards to individuals, HUFs and EOP BUIs, there has been no change in the tax rate. The tax rate continues to remain the same for the basic tax rate continues to be the same for individuals, senior citizens and super senior citizens. One may read those details. The changes, there is also no change in the tax rate for firms or for cooperative societies or for LLPs. However, and the health and education cess continues to be at 4%. There was a rebate which was claimed by assessees under section 87A. So this rebate was earlier available only up to rupees 2,500 from the tax liability. Now that has been increased to 12,500, and the income for which an assessee can claim rebate was also extended to 5 lakhs. So this is another relief which is given to assessees who claim rebate under 87A, specifically for all those assessees whose total income is less than 5 lakhs. As regards to domestic companies, the tax rate was reduced to 25% for all those domestic companies whose turnover was less than 250 crores. That limit of 250 crores is now enhanced to 400 crores. So all those companies, domestic companies who have a turnover of 400 crores in financial year 17-18, the tax rate will be 25% now. So the income tax return forms or calculation will itself guide to the calculation of taxes, and the MAT rate has been reduced from 18.5 to 15% for those domestic assessees, company assessees. For all other assessees wherein the turnover is more than 400 crores, the tax rate continues to be 30% unless they opt for the new regime for taxation, which is applicable from this assessment year. So this is just a snapshot of a new tax regime for companies. So they have brought about the new tax rates or the revised and reduced tax rates as an incentive to corporates, which was made by way of an ordinance. So the two changes which they have brought is in section 115 BAA and BAB. So there is a separate tax rate for companies which are manufacturing certain articles or production of certain things. There are conditions or there are exclusions also from such manufacturing. So all those type of companies will have a reduced rate of 15%, and all other companies will have a reduced tax rate of 22%. Now this reduced tax rate of 22% and 15% is applicable only to those companies or only to domestic companies who are availing the optional reduction of tax rate before the filing of return of income. So this is the first year for taking this option, and the assessee may take this as a option. However, the assessee who takes this option will not be allowed certain deductions. So there are certain deductions under section 35 AB. There is additional depreciation. There are certain conditions for carrying forward and set off of losses with respect to such expenses. So certain deductions and certain expenses, I will not get into detail because it is a long list. But before, the idea to put it here is that since this is the first year, an assessee, a company assessee has to evaluate which option is better, whether the reduced tax system is better or the existing one, which provides two rates, 25% for turnover below 400 crores and 30% for above 400 crores. So one has to decide which tax rate is beneficial and which option the company has to exercise while filing the return forms itself. That option one has to tick mark and proceed accordingly. There is also a difference in surcharge rates. The current structure without any optional without any optional taxation is a differential surcharge rate, which is 7% and 12%. For all the companies assessees which are opting for the optional or reduced tax rate, the surcharge continues to remain at 10% irrespective of the turnover. Also, another difference is that under the new tax regime, minimum alternate tax is not applicable, whereas it is applicable to the existing structure. So there are a lot of conditions also which the assessee has to fulfill. So one may need to read all those conditions and conditions which one has to follow before selecting the regime. As I mentioned, there was no change in the basic tax rates. However, there was a change which was made in the rate of surcharge. So, as regards to surcharge, now they have tried to tax the rich. As the income slab increases, the rate of surcharge also increases. So, we can see that we have a rate of surcharge right from 10% to 37%, where assessee has an income varying from 50 lakhs to 5 crores. Any assessee having income above 5 crores will be at the maximum rate of 37%. So this increases the effective tax rate for high net worth individuals reporting a very high income. However, this increased surcharge rates of 25% and 37% are not leviable on capital gains, whether it is short term or long term, for residents or non-residents. So one has to calculate or keep in mind, while if an assessee or a high net worth individual has capital gains income, the calculation will have to be bifurcated, wherein the regular income will follow this rates of surcharge. However, the capital gains income will be restricted to 10 or 15% of surcharge only. 25% and 37% surcharge will not be applicable to such transactions of capital gains. So that calculation has to be made from this year. For other assessees, the surcharge rate has not been increased for firms or cooperative society or LLPs. However, for domestic companies, if the turnover increases, if the income increases beyond 10 crores, then they have enhanced the surcharge rates to 12% and 5% for domestic and foreign companies respectively. Okay. Coming to the amendments which are made, I'll take it up. Try to take it up headwise of income. Wherein firstly for salary, all those assessees who have income from salary, we have a standard deduction of 40,000. That is a welcome amendment which was made, wherein the deduction has been increased from 40 to 50,000. So that will be auto calculated in the return forms itself, wherein considering the case of house income from house property, the annual value which was determined. So in income from house property up to one self-occupied property, the annual value was considered as nil. For any other, apart from one, if I have any other residential houses, then I was supposed to compute a deemed rental or a notional rental value and offer that to tax under the head of income from house property. Now they have given this benefit that assessee can claim two residential self-occupied properties with annual value as nil. So if an assessee has two residential properties, he can consider both the residential properties as self-occupied properties at the assessee's option, and the annual value will be considered as nil for those transactions, for those particular properties. Beyond that, if I will have to calculate the notional value. So as regards to that, they have made certain changes in the forms wherein we have to disclose the self-occupied properties. As regards to deduction which was available under section 24B, this is a deduction which is available in respect of the interest which is paid on loan taken for purchase of these properties. Up to 2 lakhs, the interest was available. They have clarified that this 2 lakhs limit is an aggregate limit for both the residential properties. This limit is not individually for one property. So if I have, suppose for example, if I have an accumulated interest for both the self-occupied properties of around 3 lakhs, I will restrict that to 2 lakhs and not go beyond that. I will be allowed only 2 lakhs for both the properties. This interest limit under 24B is only for self-occupied residential properties. If a property is let out, there is no restriction. So for that, there is a different limit for interest under section 24. So one needs to just clarify that in the head before making the computation. As regards to section 56 to 10, this is a gifting section under income from other sources. So under this section, any any property, immovable, immovable, or any sum of money which is received by an assessee without adequate consideration was charged to tax for the assessee who receives it. Up till now, there was no provision for non-residents, since there was no parallel amendment which was made in section 9, which is the section which mentions what is an income which is deemed to accrue or arise for a non-resident. So now they have made changes in section 2, which is the income section, definition of income, wherein they have mentioned that all those assessees, non-resident assessees receiving gift, receiving sum of money, sorry, not gift, receiving a sum of money from a resident, that income will be considered to be accrued or arisen in India under section 9. So they have made the similar change in section 9 and section 2 and 56 to 10. So now if an assessee, a non-resident assessee receives any sum of money from a resident which is beyond 50,000, then that will be charged as income under income from other sources under section 56 to 10. So if one needs to be careful for non-resident assessees if such a sum of money is paid, and also if those assessees are not filing return of income, they will have to file return of income to disclose this income. So that change, another clarification here is that this amendment pertains to only sum of money received. It is not as regards to movable or immovable property. So if I have gifted an immovable property to a non-resident, then there are no changes which have been made for that, because the section is clear to mention only a sum of money. Also, there were angel tax provisions, popularly called, which pertains under section 56 to 7b. So this is the section which taxes the excess share premium which is received over and above the fair market value. If there is a premium which is received of the share over and above the fair market value assessed under rules, rule 11 UA, then in those cases that excess was taxed to the company who receives that. There were certain exceptions which are there in the act already. In that category 1 AIFs was already there. Now they've extended that to category 2 AIFs. And startups were also forming part of that. That was a relief measure for startups to promote the startups. So now they have also clarified that there are certain conditions for those startups to avail this benefit. The exclusion which is made to the startups is only for if the conditions are met with. If the conditions are not met with, the year of non-failure, this particular income will be taxed. So that conditions needs to be strictly followed. Coming to business profits and gains from business and profession and capital gains income. So coming to section 43B. Section 43B is a section which allows us any deduction on payment basis. Interest payment on loan is one of those deductions. So any interest which is paid on loan was allowed. Now they've extended that any interest which is paid to an NBFC, whether deposit taking or non-deposit taking systematically investment NBFCs, will be allowed as a deduction under section 43B. So those will also be allowed. A clarification to that extent is also brought about, that any conversion of interest on loan shall not be considered as payment. So if I have an outstanding, if I have an interest and that interest I have converted into a loan, that will not be considered as equivalent to payment of loan under section 43B. This was always there in the act, but not for NBFC. So that clarification they have brought. As regards to deduction under section 54, it can be claimed. Deduction under section 54 was allowed when I sell a property and that proceeds of the property I invest in another property. Another residential property. But up till now, I could invest only in one property. Now, if I invest in 2 residential properties, then also it is allowed. The intention was that under the Indian system, there are families which get apart and they purchase 2 small residential properties. This deduction is now, so they have made suitable changes in the return forms, and this is available only if the capital gains does not exceed 2 crores. If it is more than 2 crores, then you cannot apply this deduction under 54, in that case only one property will be allowed, not both of them. So to that extent it is there. Now, as regards to short-term capital gains, there was a very minute change which is made in the rate of tax for funds of funds. So now any transfer of units from funds of funds will also be equivalent to equity-oriented funds. So if any investment is made in funds of funds and units are transferred, that will be equivalent and will be to equity funds, and it will be covered under section 111A, wherein a concessional rate of 15% will apply and not the maximum rate of 30%. So that rate of tax has been changed. As regards to pass-through entities, there have been considerable changes in the Finance Act, wherein and also we can see in the income tax return forms at various schedules, various heads of income, there is an additional column which is added only for pass-through entity income and losses. So all the AIFs, alternate investment funds or venture capital funds, up till now the pass-through income which is there, the business income is taxed at the entity level, which is at the AIF or VCF level. However, all other income was to be taxed to the unit holder. So except for business income, all the income was to be taxed at the unit holder. However, the similar provisions were not for losses. So now they have made amendments in the Act wherein any business losses which are there shall be allowed to be set off and carry forward at the fund level. However, all the non-business losses will be allowed to the unit holders, and they will. There is just one condition, that they will be allowed those losses only if they have held those units for more than 12 months or more. So the idea is to give advantage to the unit holders who is keeping it for a year or more, to give advantage to such unit holders, and not the one to not misuse wherein a person may purchase the unit for a certain period and just to claim losses. So just to avoid that loss stripping, they have introduced that condition. So to that extent, they have made that amendment, and also all the accumulated losses, non-business losses up till 31st March will also be allowed to that unit holder who is the unit holder as on 31st March 19. So that all accumulated losses will also be available. So if the assessee is a unit holder of such funds, then one has to take care to report or to claim the benefit of those losses. There are certain amendments which were made in the return filing provisions itself under the Act. So under section 140A, which is the calculation of self-assessment tax, there is an amendment which was made. While calculating the asset tax, we normally reduce the advance tax and the prepaid taxes like TDS. Now they have mentioned that even the relief which an assessee claims under section 89, that also has to be reduced before computing self-assessment tax. And a similar amendment they have made under section 234B and C also. So when you calculate interest under section 234BC, which is the interest on the self-assessment tax, for that purpose also this tax relief will have to be deducted. After that only one has to calculate the asset tax and the consequent 234B and C interest. So that calculation part is a change. There was mandatory filing of returns. So Finance Act 19 number 2 brought about certain parameters, 4 categories of assessees, wherein return filing is mandatory apart from whatever is your income. So irrespective of your income. So in those cases, the person has to mandatorily file the return of income under 139(1). 7th proviso was added to the Act. So for all those assessees, there is a separate disclosure or has been made in the income tax return form. Which are those assessees we will cover when we cover the income tax return forms. So just one has to see that if this will convert all those assessees who are not filing return of income into return filing assessees. So that expansion they had made in the return in the mandatory filing last year in the Finance Act. So one needs to be careful. If we have such assessees or we have such clients, then those mandatory filing of returns will have to be made this year. As I mentioned earlier, that there was interchangeability of PAN and Aadhaar card, which was provided under 139A. So this was like a relief provision which was provided to all those assessees who did not have a PAN or who did not have an Aadhaar, had just one of them. In that case, the interchangeability was allowed in reporting the transactions in the income tax return form or doing any other transactions. So that because of that interchangeability, they have made changes in the income tax return forms, wherein a person has to report PAN and Aadhaar card number at various places. So that has to be done. Non-reporting has penal consequences. Then prosecution for non-filing of return. Yes, there is prosecution for non-filing of return of income also, if you don't know. And that was there only if my returned income is beyond 3,000, which is a very minuscule or very minimum income. Now they have given, I think, we may say just a relief in that, or the so-called relief from 3,000 to 10,000. So if I have an income less than 10,000 and I don't file my return, penal consequences will continue be there, but there will be no prosecution on the assessee. Coming to the amendments which they have brought about in the return of in the deductions which we claim. So I've included these two deductions because these are the deductions. This is the first year for claiming those deductions, first assessment year. New sections were inserted. Section 80 EEA. This is the section in case this was a section which was for affordable housing. The agenda was housing for all. So this was brought about in the Finance Act, wherein any assessee who is purchasing a residential property and is taking a loan, that interest on loan will be allowed up to rupees 1,50,000, provided there were certain conditions that the loan has to be sanctioned up to 31st March 20. Now it has been extended to 21 in the last budget. However, another condition is that only those assessees can avail this deduction whose stamp duty value is not more than 45 lakhs. So it is the lower income class or all those assessees who are purchasing property which is lesser than 45 lakhs. So this additional deduction of 1,50,000 is allowed under Section 80 EEA. This deduction of interest is over and above the interest which we claim under Section 24B in income from house property. So suppose if an assessee has an interest of, take example, 2 lakhs, then 1,50,000 can be claimed here and 50,000 can be claimed under Section 24B as well. So that one has to just look into and have to claim this deduction accordingly. Under Section 80 EEB, this was a move for being more environment friendly, and hence any loan which was taken for purchase of electrical vehicles, that was allowed again up to 1,50,000. A deduction which is claimed under this section will not be allowed under any other section. So this interest was exclusive to this particular section, and there is also a sanction limit for loan which is quite later till March 23. So if a assessee has purchased such taken such kind of loans, then that interest, there are separate deduction schedules which are made for this particular deductions. Units located in International Financial Service Centers, IFSC. So there was a lot of amendments. I will not talk about all the amendments, but lot of relief amendments which were made for IFSC. The one which assists us in the income tax return filing is that earlier the deduction was restricted 100% for first 5 years, 50% for another 5 years. Now they have amended to bring about 100% deduction for all the 10 years, all 10 consecutive years, and also an assessee has an option to choose when the 10-year period will start in the 15-year span. So if an assessee wants to start, suppose from this assessment year, then it can move on and claim the deduction for another 10 consecutive years starting from this assessment year. So that schedules have been changed and provided, and the tax rates have the profit percentage is also to be changed. Coming to some other miscellaneous amendments which affects the return forms, since when we see the return forms, we'll see that these are minute changes which have been made. So secondary adjustments under Section 92C, this is the amendment which was made in transfer pricing cases, wherein an adjustment has been made by the assessee or the assessing officer, and it is any primary adjustment which is determined by APA after 1st April 2017. So when these kind of adjustment has been made, a secondary adjustment was to be made. The excess amount on secondary adjustment was to be repatriated to India within a prescribed time period. So this is important because when this amount is not received within the prescribed period, the assessee will have to calculate interest on that at the rate of 18% with surcharge and education cess, and this will be treated as an advance received from an associated enterprise. So there is a schedule which they have dedicated to this particular amendment, and the assessee can calculate the interest and provide in therein. So be careful of calculating those interests, because that interest has to be calculated by the assessee on its own, suo motu. So if the assessee does not calculate on that excess money, and if they come to know later on, they may have penal consequences or inaccurate reporting of income. So to that extent, one has to report. Section 79, which is the carry forward of losses for eligible businesses or eligible startups under Section 80 IAC, there is a restriction under Section 79 that if an entity is making a change in the shareholding of the company, then this section is not allowed. This is just that the section is not misused, or the losses are not carried forward just by changing the structure of the group. However, they have given a relief for startup companies, because startup companies in the early years or in any year may have a significant change in shareholding, because there may be investments from private equity or anyone else, or venture capital funds. So to that extent, that relief has been provided to startups by way of Section 79. And we have talked earlier in length about specified financial transactions. So earlier there was a limit of 50,000 for making any changes or prescribing different values if there is a misrepresentation or an error. Now that limit has been removed. So CBDT has, or the income tax authorities has more power to prescribe any different values or limits for specifying the financial transactions. Coming to the amendments which were brought about in 2020 in Finance Act 2020, which is as regards to the charitable trust and tax audit report, there are only these two major amendments which affect the income tax return forms. So charitable trust, the entire regime was changed in Finance Act 2020, when all the existing charitable trust and institutions claiming exemption under Section 11 or 1023C. So it could be scientific or educational research institutions or medical research institutions, etc. They all have to now apply for registration afresh, and that registration will be applicable for another 5 years. So that I have talked about, that limit has been extended till 31st December. However, the return forms give those details, wherein we have to specifically give those details, that when was the application made and what are the objects of the trust, or all those details, or whether it is accepted or not accepted. So all those disclosure related information have to be given in the ITR 7, which is the return form for such kind of organizations or such kind of institutions. The only thing which one needs to ponder here is that since the deadline for submission was 31st December, extended to 31st December, the return form deadline is only 30th November. So there may be certain kind of organizations who have not made an application, or is supposed to make an application in the month of December. So such organizations will not be able to fill in those details in the return forms. One needs to know, we don't have the utility yet, so we don't know whether if the charitable trust organization does not fill in those schedules, whether there is an error coming up, or whether there is a validation error coming up or not. So that will come to know when the utility comes up, but till then we don't know that. But if it creates an error, or it doesn't allow the charitable trust to file the return, then it is a potential problem or an issue, because there is a mismatch in the due dates. So probably the only way out from there is to well in advance make the application, not wait for the month of December, but to make those applications afresh before 30th November itself, so that we can report in the income tax return forms. And lastly, there were changes in the tax audit limits. So this was a very welcome move or change which was made in Finance Act 20. However, applicable for all the returns filed for assessment year 2021. So up till last year, the limit was 1 crore. So if you have a turnover more than 1 crore, then tax audit was applicable under section 44AB. Now they have enhanced that limit to 5 crores only if two conditions are fulfilled, wherein the aggregate of receipts in cash or cash receipts or cash payments does not exceed more than 5% of the aggregate receipts and aggregate payments. So if that condition is satisfied, one may skip doing tax audit altogether if the turnover is less than 5 crores rupees. Now there are various situations which the assessee will come up or crop up while calculating what is aggregate receipt and payments. So indicatively, on just blanketly, if we can say, all the receipts and payments which are in relation to the business of the assessee, maybe capital receipts or revenue receipts. So all debtors which have been received or creditors which have been paid, or probably all the loans which have been repaid, loans which has received, will be forming part of it. Outstanding balances as on the year end will not form part of this limit, because it says receipts and payments. It does not mention outstanding. So one has to be careful in calculation of that what is an aggregate receipt and what is an aggregate payment. Even capital receipts, so purchase of fixed asset or sale of fixed assets, or maybe receivables or any other arrears received on account of business. So there will be multiple scenarios, multiple receipts and payments. One needs to be very careful in documenting what is aggregate receipt and payment, and then calculating the cash receipts and payments and formulating what is 5%. So the only irony here is that the person who wants to avail this limit, or wants to avail the benefit of this enhanced limit, will have to actually go to an accountant and classify. Though the audit will not to be done, but he has to still take the pains to classify what is aggregate receipts and aggregate payments. And one needs to be very careful in classifying, because a issue may come up later on, that why it was why this particular payment or receipt was not considered in the calculation. This is relevant because this will determine the tax audit due date also, as well as in the income tax return forms we will have to provide the details of tax audit. So that needs to be taken care of, or that needs to be determined well in advance before 31st October, because for tax audit, I'll remind that the limit is 31st October and not 30th November. So one has to do that. There will be different scenarios. Just few scenarios which I have covered is that suppose if the turnover is less than 5 crores and considering a blanket simple plain vanilla situation where a turnover is less than 5 crores and my cash receipts does not exceed 5%, I will not do tax audit. However, if my cash receipts exceed 10%, suppose it is more than 5%, take an illustration of 10%. If it is 10%, then the tax audit will have to be done. However, there is always a limit of 2 crores which is there for presumptive taxation under section 44 AD. So one needs to not forget that limit which is there under section 44 AD, which is 2 crores. So suppose if in under 44 AD we have differential tax rate, 6% for non-cash transactions and 8% for any other transactions which are not through electronic medium. So in such cases, if a person is a person which is there between the limit of 2 crores and 5 crores, if it is reporting a lower percentage profit, suppose 4% profit or 3% profit, still tax audit is not applicable. However, if an assessee has a turnover between 1 crore to 2 crores and is reporting a profit percentage less than 6%, suppose 2%, then that assessee will have to mandatorily do tax audit under section 44 AD. Read with section 44 AB and not under 44 AB. So that, to that extent, the provision is a little unfair or biased towards all the assessees who are having a turnover above 2 crores. It is beneficial to those assessees. So one, with that different typical scenario, one has to consider. Do not forget to see all the limits, 1 crores, 2 crores, 5 crores before determining what is applicability of tax audit. So yes, with this I complete my section, and I'll hand over to Vishesh for talking on the practical nuances of the changes which have been made.
Kinjal, before we go to the Vishesh,
Yes,
we have certain questions regarding your
sure.
presentation. I think we'll take a few minutes. We can start now that.
Yes, yes, we can take. Yes,
Our
sure.
past president Kamal Bogadia has asked for that loss on derivatives whether tax will be required because there is no cash transaction. In case of derivatives loss, whether tax will be required since there is no cash transaction.
Sir, loss on derivative transactions will be still forming, as I mentioned, that it will still be forming a part of the 44 AD limit. So in case, even if there is a loss and you are not reporting any profit, then you will have to do tax audit, if not under 44 AB, under section 44 AD. So in those kind of transactions where since you are not reporting a profit percentage, then you will fall under that and you will have to do tax audit.
Okay. The next question is GST included in the turnover, whether GST is going to be included in the turnover.
So yes, so there is so as respects to what will be considered in the turnover should be guided by the revised guidance note on tax audit, wherein they have specifically given us that what could be turnover, what all receipts could be, and what all payments should be on turnover. So this will depend also on the method of accounting of the assessee. So whether a assessee is having an exclusive method or an inclusive method, depending on that, the GST will be included or excluded.
Some question was raised regarding that whether somebody has inherited third property in the Rajasthan and which is very old, 90 years and not habitable. So whether it has to be offered national rent on that property.
So if it is a third residential property, then ideally it was to be offered for all the years when it was hold, but one can start from this year then if it is missed.
Okay. Another question from Sri Ramata Joshi is whether details of all self-occupied property are required to be given ITR.
I think that will cover up in detail when we show the schedule, because the schedule has a specific. It shows we have taken the screenshots of the schedules and put in the presentation.
Kinjal, one more question.
Yes.
Doubts were raised regarding interest under 234 B and C applicability and calculation because return dates have been enhanced. So how is it going to calculate 234 B and C?
So up till as far as what I know, up till 30th June, there was a concession which was provided wherein only 9% rate was applicable and not 12%, which is 1% per annum. But now for all the new return forms, there is no concession which is there given for interest under section 234 B and C, as to my mind, because in the notification and the ordinance they have specifically made comments only for interest under section 234A. They have not made any comment for 234 B and C. So as to my mind, it will continue to be applicable. Just one thing I missed out saying for 234A, that 1 lakh limit is not applicable for senior citizens. For senior citizens, they have given that exemption that they don't have to calculate that 234A interest even if they pay after July or September.
Yeah, that same question you asked by someone else in the mail.
Okay, I missed talking that in the paper.
You have answered that question. Another question is if profit is below, this is the last two questions we are going to take now.
Yes,
if profit is below exemption limit, even in derivatives, no 44 AD. Am I right?
If profit is, if profit is
below exemption limit,
below exemption.
Even in derivatives, 44 AD is applicable.
No, so if there is, see, 44 AD has a specific subsection 5, wherein it says if only if a lower profit percentage and if the income is more than the maximum marginal limit. So both the conditions has to be followed together. If either of the condition is not there, then that subsection 5 is not applicable. So if the limit income is below the maximum marginal limit, then the compulsory tax audit will not be applicable under 44 AD.
One question from last question from Mr. Rakesh Jain. If we pay our challans before 31st July, any information on chargeability of section 34A, B or C?
Yeah, so if, okay, in the sense, if is it a question when the tax liability is less than 1 lakh?
Assume it is more than 1 lakh.
So if it is more than, see, even if it is irrespective, if it is less than 1 lakh or more than one, if it is more than 1 lakh, then 234A will definitely not apply. But in any regular case also, if it was not a COVID situation, but if I pay my self-assessment tax today, even before 3 months, then to that extent the interest will anyways reduce, because the interest is only from the date of, if it is 234B, then it is from 1st April till the date of payment of asset tax, and not till the date of due date of return. Due date is linked only to interest under 234A, not with 234B and C.
Thank you, Kinjal. I think we will
Thank
now
you.
move on to the next
Yes.
speaker. Yeah, please.
Sanjay ji,
Our question
one
number-
question Kinjal said regarding GST on GST inclusion in turnover, and Kinjal said that whether the exclusive method or inclusive method is followed, but we have in tax audit report section 145A reference, 145 capital A, as well as we have a very old judgment of McDowell, which was
Yes.
connected with VAT. So would it not be safer that we consider turnover inclusive of GST? Even if the accounts are maintained, mostly corporates are maintaining on exclusive method, but I think it will be safer to include GST while counting, while calculating the limit for tax audit. What are your views on this?
I think yes, considering what is there in the past, the decisions is there, but there has always been controversies whether you should include the earlier it was VAT, so whether you should include that or not. As you mentioned, that it would be always better to include it just to avoid or bypass with the department and to not have it. But in some cases, if it is very significant, the GST portion is very significant. In that case, one may have an exclusive system. So I think it will be definitely a choice which is made by an assessee, depending on the risk which the assessee is trying to take, like whether it is an aggressive thinker or a liberal one. But yes, it is always better to be inclusive and add GST in the turnover portion.
Thank you. Thank you.
Thank you, Kinjal. Thank you very much.
Yeah.
I think Sanjay ji, DN Agarwal ji was asking some question.
I didn't saw him in the chat box. Mr. DN Agarwal, are you there? DN bhai, have you joined it?
No, he is there, definitely is there. And I
He's
think
there. Last moment he joined it, but we'll take up the question later on because we are getting
okay,
now
we'll
late
take up
now.
it later.
Yeah,
Okay,
we
okay,
can
yes,
take at
sure,
the end
sure,
also.
sure.
That's fine. Yeah.
Okay, sure.
May I request Vishesh to take over the proceeding now?
Yes, sure.
Thank you, Vishesh.
Thank you, Sanjay ji.
You're
A very
sharing.
good evening to.
You're
A very
sharing.
good evening.
Vishesh, your sharing has not started.
Can you see my screen now?
Yeah, now.
Yeah.
It's okay now.
Yes, we can.
Great. A very good evening to everyone. We are in the month of August 2020, and I'm sure most of us have commenced the tax filing season for assessment year 2021. Since last couple of years, we all have been witnessing that the tax department is adopting information technology at a very rapid speed. In fact, last month we would have seen quite a few clients receiving emails as a part of an e-campaign for high-value transactions. Now, when you click on those emails to respond to those campaigns, you get redirected to another portal called Project Insights. This Project Insights is a flagship project of the Income Tax Department. They have spent more than 10 billion rupees to create this large data warehousing and business intelligence platform. The main aim to create this platform was, to widen the tax base using technology. So they collect information not only from the traditional sources, which are the banks, the financial institutions, the registrars, but they also look at the social media websites just to track the spending patterns, which is then compared with the income declarations. To my mind, this is certainly going to be a game changer for the income tax department, and they would be easily able to catch the non-filers and even the filers who are, spending more and declaring lesser income. With this, it's imperative to understand what are the changes and the amendments as far as the income tax returns are concerned for assessment year 2021. Firstly, who is required to file an income tax return? The statutory condition to file an income tax return is provided in section 139(1). Clause A states that a company or a firm, irrespective of their income or their loss, are mandatorily required to file the income tax return. Clause B states that a person other than a company or a firm, if the total income of that person exceeds the basic exemption limit, that person is required to file the ITR. These are the two primary conditions in clause A and clause B. Now, there is an interesting fourth proviso to section 139(1)(b), which states that a resident person, even though his total income does not exceed the exemption limit, but if that person holds any foreign asset outside India or is a beneficiary of any asset located outside India, he is required to file the ITR. Let's understand this with the help of an illustration. Suppose an Indian student after completing his graduation in India goes to Canada to pursue an MBA degree. For financial year 1920, he was a resident. He goes to Canada in November 2019 and he spent more than 182 days in India. While he was in India, he has earned an interest income of rupees 1 lakh, and apart from that, there is no other income. When he goes to Canada, he opens a bank account out in Canada. So if you see for financial year 1920, even though his total income does not exceed the exemption limit, just because he's opened a bank account outside India, he's required to file an income tax return for financial year 1920. Moving on to the next proviso, sixth proviso to section 139(1)(b). There is a small amendment in this proviso which is effective from assessment year 2020, which is the current assessment year. Let's understand this with the help of an illustration. Suppose Mr. A sells his house property and earns a capital gain of rupees 10 lakhs. He has reinvested the capital gain of rupees 10 lakhs in another flat and thereby he wishes to claim deduction under section 54. Apart from this transaction, he has earned only an interest income of rupees 1,50,000. There is no other income. Now, the amendment in this sixth proviso states that if the total income of a person, before giving effect to the deductions under sections 54 to 54 GB, if the income exceeds the exemption limit, the person is required to file an income tax return. Thus, in this example, before giving effect to the deduction of section 54, the income exceeded the exemption limit and hence is required to file an ITR. Moving on to the next important seventh proviso to section 139(1)(b). Another proviso which is effective for the first time from assessment year 2021. Now, before inserting this proviso, Income Tax Department realized that one of the possible ways by which a large number of taxpayers, by which they can be brought under the tax net, is to identify taxpayers through economic indicators. And hence, with that aim, with that objective in mind, this proviso has been inserted. Similar provisions were there in the Act up to assessment year 2006-2007. After that, which they were omitted. Some of the provisions have been reintroduced now and are effective from assessment year 2021. Seventh proviso states that if a person other than a company or a firm, if that person, even though the income of that person does not exceed the exemption limit, but if that person fulfills any of these three conditions, is required to file the ITR. The first condition, it states that a person has deposited an amount or an amount, aggregate of an amount exceeding 1 crore in one or more current accounts. Now, the term deposited an amount, this is a very important term which we need to understand. Mind you, it does not talk about cash deposits, it talks about any deposit. That deposit could be either through cash or it could be any other deposit through banking channels. Probably if a person receives any sort of gift in his bank account, or if the person has received any loan in his bank account, if the total of your credit transactions in your bank account, if that exceeds 1 crore, this condition gets fulfilled and that person is required to file the ITR. Very important condition. The second condition states that if a person has incurred expenditure of an amount or aggregate of amount exceeding 2 lakhs, either for himself or for any other person, for travel to a foreign country. So it talks about foreign travel expenditure. The expenditure could have incurred either by cash or through forex card or maybe debit card or credit card. The expense could have been incurred either for himself or even for some other family member or any third party. Even the purchase of air tickets would require to be factored in calculating the foreign travel expenditure. So if this total expense exceeds 2 lakhs, that person is required to file the income tax return. And the third condition in 7th proviso states that if a person has incurred expenditure of an amount or aggregate of amount exceeding 1 lakh rupees towards consumption of electricity. So again, here consumption of electricity could either be for residential purpose or maybe for business purpose. This condition is specifically introduced to keep a check on those people who are, carrying on some sort of business activity either through their houses or through small places, and the most of the transactions are not through banking channels. Consumption of electricity exceeding 1 lakh is an indication to the income tax that some sort of business activity is being carried out, and if that person is not filing income tax return, this condition would get triggered and he would be liable to file the tax return. These are the three conditions under 7th proviso to section 139(1)(b). To incorporate these amendments in the ITR, certain columns have been added in the scheduled general information in ITRs 1, 2, 3, and 4. Now, the taxpayer is required to tick the checkbox as to if he's filing the return just because one of the conditions under 7th proviso is getting fulfilled. If the taxpayer selects yes, he has to specify which of the three conditions he is getting fulfilled. If condition number 1, which talks about deposit, is getting triggered, he has to specify the exact amount of the total deposits in the bank account. Similarly, if condition number 2 or condition number 3 is getting fulfilled, the taxpayer is required to indicate the exact amount of the foreign travel expenditure or the exact amount of the electricity charges incurred during the year. Moving on to the next slide, Prime Minister Modi ji addressed the nation on 13th August on the theme Transparent Taxation and Honoring the Honest. Prime Minister Modi ji remarked one thing, that the economic reforms which are being introduced by his government are mainly to achieve threefold objectives. The first objective being banking the unbanked, secondly, funding the unfunded, and thirdly, securing the unsecured. To my mind, Prime Minister Modi ji missed out mentioning one thing, or probably he wanted us to read between his lines, is the phrase taxing the untaxed. Perhaps this could be seen from the host of measures which are being introduced by the government to track down the non-filers. Soon after the Prime Minister's address, the Finance Ministry rolled out an announcement on its Twitter handle, and I have just copied that announcement made on the Twitter handle over here. The first part obviously talks about the expansion of the scope of SFT. Kinjal has enlightened us on this topic. The second part, which I have highlighted in red, talks about tax return filing. The first announcement, just keep in mind these are mere announcements. They are not effective as on the current date. Probably later or sooner they would be introduced in the Act. And the first announcement talks about deduction or collection of tax at higher rate for non-filers of return. And the second announcement talks that compulsory filing of return by three category of people. Firstly, a person having banking transactions above 30 lakhs. Secondly, all professionals or businesses having turnover more than 50 lakhs. And third category would be payment of rent above 40,000. These are mere announcements. We need to keep them in mind for future transactions. Sooner or later, they would be introduced in the Income Tax Act. Moving on to the next slide, coming to the ITR forms for AY 2021. This year, on 3rd of January 2021, in a surprisingly welcome move by the CBDT, they had notified two forms, which were ITR 1 and ITR 4. It was a very welcome move because CBDT for the first time had notified the forms much well in advance before the tax filing season. Generally, these forms are notified in the last week of March or probably in the early days of April. However, this year they had notified two forms in the first week of January itself. All tax professionals like us felt that even the other forms would have been rolled out pretty soon. However, unfortunately, the country was facing the pandemic crisis, which also led to the delay of notification of the ITR forms. Finally, a notification was issued on 29th May 2020, wherein ITR 1 to 7 were notified. This notification superseded the earlier one, and hence the earlier ITR 1 and 4 were re-notified again. As far as the return filing utilities are concerned, the only return utilities for ITRs 1, 2, 3, and 4 are available on the income tax portal. The utilities for ITRs 5, 6, and 7 are yet to be released. Moving on to the applicability criteria of ITR forms. As far as the applicability criteria is concerned, there is no major change. ITR 1 is applicable for individuals, resident individuals having income up to rupees 50 lakhs and they hold one house property and the agricultural income does not exceed 5,000. ITR 2 is applicable for individuals and HUFs not having income from business or profession. ITR 3 would be applicable for individuals and HUFs having income from business or profession. ITR 4 would be applicable for presumptive taxpayers. An important thing to be kept in mind is ITR 1 and ITR 4 would not be applicable to an individual who is either a director in a company or if that person holds any unlisted equity shares. ITR 5 is applicable for all persons other than an individual, HUF, company, or persons required to file an ITR 7. So practically all the partnership firms, the LLPs, the unregistered charitable trusts are required to file ITR 5. ITR 6 is applicable for companies other than those companies who are claiming exemption under Section 11. And ITR 7 is applicable for registered charitable trust, political parties, electoral trust, and so on. Moving on to the important changes in the ITR forms for AY 2021. What I have done is I have created separate buckets and we can discuss the reforms headwise or as per the buckets. The first set of amendments in the ITR, which is primarily due to the COVID-19 pandemic, is Schedule DI. Now, if you remember, on 31st March 2020, an ordinance was promulgated by the President of India. And according to that ordinance, the time limit for claiming deduction for financial year 1920, to claim deduction under Chapter 6A, to claim deduction under Section 10AA, and from Sections 54 to 54 GB, the time limit was extended up to 30th of June 2020. Further, by way of a notification on 24th June 2020, this time limit was further extended to 31st July for few sections and 30th September for few another sections. To incorporate all these amendments, Schedule DI has been inserted in ITRs 1 to 6. Under Schedule DI, in column 1, various sections have been enlisted. Under column 2, the taxpayer is required to disclose the eligible amount of deduction which could be claimed for financial year 1920. And in column number 3, the amount which has been invested from 1st of April to 31st July, which is eligible to be claimed as deduction for financial year 1920. So in this first example, if for a person, the eligible amount to claim deduction under Section 80C is rupees 1,25,000, this amount is specified in column number 2, and in column number 3, the taxpayer is required to intimate the amount which has been invested from the period 1st of April to 31st July 2020. So in this case, the eligible amount of deduction is 1,25,000, and the taxpayer has paid 25,000 in supposedly in April. Then he can indicate that amount in column number 3. One thing which needs to be kept in mind is that if a taxpayer has invested or made some payments towards premiums, if these payments are made from 1st of April to 31st July 2020, it is not necessary to claim this deduction for financial year 1920. It is an option available to the assessee. He could either claim it for financial year 1920 or for financial year 2021 on payment basis, depending upon his tax exemptions and tax calculations. Moving on to the next slide, under Schedule DI, for ITRs 3, 5, and 6, certain additional columns have been added, wherein the first part of Schedule DI talks about the eligible amount of deduction under Section 10AA. If any of those conditions are fulfilled by the taxpayer, during the period 1st of April to 30th September, he has to specify them in this schedule. And the second part talks about the deductions under sections 54 to 54 GB. If the taxpayer has invested or invested in another house property or another bonds, then the amount which has been invested from 1st of April 2020 to 30th September, that amount has to be specifically mentioned in column number 3. This column number 3 has been specifically inserted in the ITR form just to keep a track that the taxpayer is not claiming double deductions. Deduction in year 1, which is financial year 1920, and deduction under section financial year 2021 on payment basis. Just to keep a track that there is no double advantage or no double deduction taken by the taxpayer is required to denote the amount, exact amount which has been invested during this period. Moving on to the next set of amendments, the general amendments in ITR. The first general amendment in ITR pertains to the document identification number. Now, we all know that CBDT has made it a mandatory requirement for all the tax authorities to quote the document identification number on each and every notice or the correspondence sent to the taxpayer. This was just to keep a proper audit trail of all the communications between the taxpayer and the tax department. And thus, if a taxpayer is filing an ITR in response to notices under section 139(9), 142(1), etc., etc., the taxpayer is now required to intimate the document identification number which is mentioned in the notice. The next set of amendment pertains to the directorship details and holding of unlisted shares. Now, if a person is a director in a company or if he holds unlisted equity shares, he is required to disclose certain information pertaining to that company. An additional column has been inserted in this year's ITR forms, wherein now the taxpayer is required to indicate the type of the company as well. There would be two options under the type of company. One would be domestic company or the foreign company. If the taxpayer selects domestic company, he would be required to quote the PAN number, and in case of foreign company, PAN number would not be mandatory. Similar information would also be required when the assessee is disclosing details about the unlisted shares. The next general amendment pertains to the scheduled audit information in ITR 3, 5, and 6. As Kinjal has explained us that up to assessment year 1920, if a person is carrying on business, he is required to get his books of accounts audited if the turnover exceeded 1 crore. Now, this threshold limit of 1 crore has been increased to 5 crores, provided two conditions are fulfilled. The first condition being that the total cash receipts does not exceed 5% of the total receipts, and the second condition is the cash payments do not exceed 5% of the total cash payments. To incorporate these amendments, certain columns have been added under the scheduled audit information, wherein the assessee is required to tick the checkbox, and if the assessee selects that the cash receipt has exceeded 5% or the cash payments have exceeded the 5%, the tax audit would be applicable to that taxpayer. Moving on to the next set of general amendments, the option to quote PAN or Aadhaar in various schedules. Now, if you remember, in the finance speech of Finance Bill 2019, Finance Minister Nirmala Sitaram mentioned that 120 crore Indians now possess an Aadhaar card. And just to make, just for the purpose of ease and convenience, they would want to make a PAN and Aadhaar interchangeable. Subsequently, an amendment was made in section 139A to allow interchangeability of PAN and Aadhaar. To incorporate these amendments, the various schedules in ITRs 1 to 7 have been amended, and now the taxpayer can quote either the PAN or the Aadhaar of the opposite party or the second party. The ITR forms contain various schedules where the taxpayer is required to quote the PAN of the tenant or the buyer or maybe the auditor, the representative assessee. Now, in all those schedules, he could either quote the PAN of the person or the Aadhaar of the person. A very welcome move as far as the bank account for refunds are concerned Up to assessment year 1920, all the taxpayers were required, to indicate all the bank accounts held during the year, and he could indicate only one bank account in which the taxpayer would like to get the refund. From this year, the taxpayer is allowed to select multiple bank accounts, for processing of refunds. Hopefully, this solves the problems or the headaches where refunds are not processed due to the banking problems. Another very important amendment as far as non-residents are concerned, if a non-resident was claiming an income tax refund in their ITR forms, and if that person did not have a bank account in India, it was a nightmare for them to, receive those income tax refunds. From this year, now the non-residents can also disclose their foreign bank account in which they would be allowed to receive their income tax refunds. Moving on to the changes in the ITR headwise, a small amendment in the scheduled salary. Now, from this year, government employees have been bifurcated into central government employees and state government employees. Another option of not applicable would also be available under the head nature of employment. Probably the taxpayer could select the option not applicable in case he is receiving some sort of family pension. Moving on to the head income from house property, another small amendment in Schedule HP. Now, up to assessment year 1920, in case of ITR 5 and 6, only two options were available under the head nature of house property, which were let out and deemed to let out. If you see section 23 subsection 5, it states that if a person is holding a property or land, and if that property is being held as stock in trade, then the annual lettable value of that property is considered as nil for 2 years, from the 2 years up to the year in which the completion certificate was received. Considering these provisions of section 23 subsection 5, from this year, the taxpayer has been given an option to select self-occupied in the schedule HP. And in case, the taxpayer is holding those properties as stock in trade, now he could select the option of self-occupied. Moving on to the head profits and gains from business or profession. Up to assessment in 1920, 3 blocks were available to calculate depreciation on plant and machinery, which were 15%, 30%, and 40%. On 23rd of August 2019, Finance Minister, as a part of this stimulus package and in order to give a boost to the automobile sector, made 2 announcements regarding the automobile sector. The first announcement was an additional depreciation of 15% on motor vehicles purchased from during the period 23rd August 2019 to 31st March 2020. And second announcement was an introduction of another block of 45% for specific motor buses and motor lorries which were purchased during this period of 23rd August to 31st March 2020. To incorporate these amendments, another block of 45% has been introduced in Schedule DPM as far as ITR 3, 5, and 6 is concerned. Now, if you see the fourth block of 45% is available in these schedules. Consequential amendments are also made in Schedule DEP and Schedule DCG, which talks about the deemed capital gains. The next set of amendments as far as the head profits and gains from business is concerned, these amendments pertain to Part A, which talks about the other information. An additional column has been added in point 8H to report disallowances under Section 40 Clause BA. Section 40 Clause BA talks about disallowances in case an AOP or BOI pays any sort of an interest, salary, or bonus to its own member. If the AOP, resorts to any such payments, it is required to be disallowed under this section, and hence to enable reporting of disallowances, this point has been added in point 8H. Another column has been added in point 11DA. If you remember, Section 43B has been amended in order to provide that if any interest is paid on a loan taken from a deposit-taking NBFC or a systematically important NBFC. In these cases, interest would be allowed only on payment basis and not on accrual basis. To report these sort of disallowances, a column has been added over here. And lastly, point 17, a column has been added wherein the assessee is required to intimate whether any secondary adjustment is required during the year. We'll talk about the secondary adjustments in the coming slides. Up to assessment year 1920, there was no requirement for separate computation of income from life insurance business under section 115B. From this year, from assessment year 2021, an amendment is made where in Schedule BP, wherein the assessee is now required to separately disclose information relating to the life insurance business, wherein he is required to disclose details about the net profit and loss, the additions, deductions, and the net income under section 115B, a small amendment. Moving on to the important amendment as far as capital gains is concerned. Now, if you remember section 112A, which talks about long-term capital gains on sale of listed equity shares and units of the equity-oriented funds. This section was introduced with effect from assessment year 1920 itself. Now, when the ITR forms for the earlier assessment year 1920 were notified, this specific schedule was not included in those forms. Later on, when the Income Tax Department released the utilities on its portal, this schedule was inserted, and the schedule required the taxpayer to disclose details of the long-term capital gain on scrip file. After a lot of hue and cry, Income Tax Department clarified that this Schedule 112A would be optional for assessment year 1920. The taxpayer could report details regarding the long-term capital gain either in Schedule Capital Gain itself or in Schedule 112A. This was for assessment year 1920. For this assessment year for assessment year 2021, which is the current assessment year, this schedule has been made mandatory now. And now the taxpayers are required to report the details of the long-term capital gain on the scrip file. The taxpayer is required to intimate the ISIN code of each and every scrip or the unit, the name of the shares or the units, details regarding the number of shares sold, the sale price, the cost of acquisition, the FMV as on 31st January 2018, so on and so forth. These reporting requirements would certainly be cumbersome in case the taxpayers are having huge number of transactions during the year. Coming to the next slide, section 112A was applicable to resident taxpayers. Similarly, section 115AD, subsection 1, clause B, third proviso, is applicable to non-residents earning long-term capital gain on sale of listed equity shares. Similar sort of reporting requirements are being introduced for non-residents as well in this schedule. Moving on to the next set of amendments as regards to capital gains is concerned. This amendment pertains to the surcharge rate as far as capital gains is concerned. Now, if you remember, the enhanced rates of surcharge were introduced by Finance Act 2019, Finance Act number 2 of 2019. They had introduced two additional surcharge rates of 25% in case the income exceeded 2 crores and another rate of 37% in case the income exceeded 5 crores. Now, after these amendments were introduced, a lot of concerns were raised by the foreign investors. To address their concerns, the additional surcharge rates of 25% and 37% were withdrawn on individual HUF, AOP, and VOI only in respect of tax payable arising out of long-term capital gain or short-term capital gain earned under section 111A or 112A or under section 115AD. Only for these three set of incomes, the enhanced surcharge rates were made inapplicable. Considering the non-applicability of these surcharge rates, specific amendments are made in the ITR forms. So under Part B of the computation of tax liability on total income, Under the head surcharge, separate columns have been added, and the first column talks about applicability of surcharge at 25% in case the taxpayer is having incomes under section 60A to 69D. Subcolumn number 2 talks about applicability of 10% or 15% in case the taxpayer has earned income or income under section 111A or 112A, which talks about the long term or the short term capital gain on sale of listed equity shares. And the third column talks about the balance income. In the third column, if the taxpayer has earned other income more than 2 crores or 5 crores, the enhanced rates of 25 or 37% would be applicable. Moving on to the next head, income from other sources, a very small amendment as far as ITR 6 is concerned. In case a domestic company is receiving dividend from a foreign company, which is chargeable to tax under section 115 BBD, separate disclosure is required in schedule other sources as well as in schedule SI. A small amendment. Another small amendment as far as foreign companies is concerned, if a foreign company is receiving specified royalty or an FPS income, which is chargeable to tax at the rate of 15%, certain disclosure requirements are made in schedule other sources as well as in schedule SI. Going on to the next head, the next bucket, which talks about the deduction under chapter 6A. An important schedule for section 80D has been inserted in ITRs 1 to 4. Now the taxpayer is required to give out additional information. The first question being asked is whether the taxpayer himself or any of his family member is a senior citizen. The taxpayer is required to say yes or no. The second question which is asked here is whether any of your parents is a senior citizen. The taxpayer is required to select yes and no. And after that, the taxpayer is required to intimate the premiums paid under the various subheads. For example, the health insurance paid for the self or the family, the preventive health checkup, similar premiums paid either for their parents, and finally, the eligible amount of deduction which could be claimed under section 80D is derived. Certain columns have been added to enable the taxpayer to claim deductions. For example, in ITRs 1, 2, 3, and 4, additional columns have been added to enable deduction under section 80E, 80EA, and 80EB. The taxpayer can claim interest on housing loan as well as interest on loan taken for acquisition of electric vehicles. Now, columns have been added so that the taxpayer can claim these deductions. Similarly, column has been added to claim deduction under section 80LA, which talks about deduction for 10 years out of 15 years in case a unit is situated in international financial services center. And lastly, a column has been added to claim deduction under section 80PA, which is applicable to producer companies. Moving on to a very important amendment as far as pass-through income is concerned. Now, if you see, Income Tax Act provides pass-through status to few entities like the Real Estate Investment Trust, the Infrastructure Investment Trust, or maybe Category 1 or Category 2 AIS. An entity is given pass-through status, these entities can pass through their income to the ultimate investors without paying any taxes. Meaning, tax is charged at the investor level and not at the entity level. This is the meaning of the pass-through status. Now, Finance Act 2020 has made an amendment in section 115 UB to provide that along with pass-through of income, certain investment funds can even pass through their losses to the investors. To enable these amendments, certain columns have been added in Schedule PTI. Now, firstly, the taxpayer is required to intimate the section under which the investment is, the entity is registered. Either it could be 115 UA or UB, the name of the trust, the PAN. And coming to the newly added column, now the taxpayer is given an option to intimate the exact amount of loss which has been, passed through that individual investor. If that loss has been passed to the investor, he is eligible to set it off against his own other income. Similar sort of columns have been added in Schedule CFL, which talks about carry forward of losses. Under the column house property loss, short-term capital loss, and long-term capital loss, a new column has been added just to enable the taxpayers to denote the amount of loss which has been passed through from the pass-through entities. Moving on to the amendments as far as transfer pricing is concerned, secondary adjustment, the concept of secondary adjustment was introduced by Finance Act 2017, and a new section 92CE was inserted. This section provides that in case of a primary adjustment, there is a reduction in losses or increase in income of the taxpayer, and the excess money is lying with the associated enterprises, that excess money is required to be repatriated back to India. Let's understand this with the help of an example. Suppose an Indian company is paying an interest of rupees 1 crore to its associated enterprise situated in Singapore. Now the arm's length price of this transaction comes out to rupees 80 lakhs, and thereby an amount of rupees 20 lakhs has been given to the Singapore company, which is in excess. So section 92CE states that excess money of 20 lakhs is required to be repatriated back to India. And if it is not repatriated back to India, it would be considered as an advance given to that associated enterprise, and the Indian company is required to offer interest income. Now, another amendment is made in this section 92CE, which states that if that excess money which is lying with the associated enterprise, if it is not repatriated back to India, then the Indian company has an option to pay an additional income tax of 18% plus surcharge on this money. And if this additional tax is paid, then there is no requirement to get those funds back to India. To incorporate all these amendments, a new schedule TPSA has been inserted in ITR 3, 5, and 6, wherein now the assessee is required to disclose the amount of primary adjustment, the excess money which is lying with the associated enterprise, the amount of tax at 18%, and lastly, the tax payment details. Moving on to the specific changes as far as ITR 6 and ITR 7 is concerned. Firstly, ITR 6, Kinjal has explained us, the various alternative taxation regimes which are available to the companies, the domestic companies, for assessment year 2021. A column has been added in ITR 6, wherein the companies are now required to intimate whether the company is opting to get taxed under section 115BA, 115BAA, and 115BAP. The company is required to tick the checkbox. An important thing to be kept in mind is before the company files its ITR Form 6, the company is required to exercise the option of availing the alternative taxation regimes. If the company wishes to claim the taxation regime under section 115BA, form number 10IV is required to be furnished. Similarly, if 115BAA is to be claimed, then the company is required to furnish information in form number 10IC, and form number 10ID would be applicable for section 115BAB. An important thing to be kept in mind is these forms are to be furnished only in year 1, and in subsequent years it would be applicable compulsorily, and these forms are to be furnished on or before the due date for filing returns. Moving on to the next change in scheduled key persons. Up to assessment year 1920, only a managing director could sign and verify the ITR forms. In case the managing director was not available, any other director could execute or sign the ITR forms. From assessment year 2021, any person who is authorized by the board of directors can sign and verify the ITR. To enable these provisions, certain columns have been added in the scheduled key persons, and now the company is required to intimate the name, designation, address, and the PAN or the Aadhaar number of the person who is actually verifying the ITR form. Moving on to the next head, Schedule SH1, which talks about shareholding of unlisted companies. This schedule would no longer be applicable in case of Section 8 companies and companies limited by guarantee. A small amendment as far as Schedule SH1 is concerned. Moving on to ITR 7. Now, as Kinjal explained us that, the taxability, tax provisions as far as the charitable trust is concerned saw a major, massive change, which is effective from assessment year 2021. Section 12AB has been inserted, and which this section replaces the old Section 12AA. This section states that if an already registered charitable trust under Section 12AA, these trusts are required to re-register themselves under Section 12AB. Similar amendments are also made in Section 1023C and Section 80G. The original effective date for re-registration was 1st of June 2020. However, due to the pandemic, the date was extended to 1st of October 2020. And now the trusts are required to re-register themselves within 3 months from 1st of October, meaning thereby they can re-register themselves from 1st of October to 31st December 2020. Hopefully, the re-registration formalities are out soon by the Income Tax Department. So to enable these amendments, certain columns have been added in Schedule General Information in ITR 7. And now the charitable trust is required to intimate whether the trust has made an application for re-registration under the new provisions. The trust is required to say yes or no. Secondly, the trust is required to denote the section under which the registration is applied. It could be either under Section 12AB or Section 80G, or Section 1023C. Thirdly, the date on which the application is made or approved as per the new provisions. And lastly, the section of exemption which is opted to be claimed under the new section. These are the 4 columns which are newly added. Moving on to the next set of amendments, a small amendment is made in Schedule ER. This schedule is applicable only to those entities who claim exemption under Section 11 or under Section 1023C. So if the charitable trust is required to disclose information relating to their revenue expenditure or any sort of amounts which are spent towards the object of the trust in this specific Schedule ER. If a charitable trust which is registered under Section 12AA gives a corpus donation to another charitable trust which is also registered under Section 12AA, this corpus donation is not allowed as an application of income. It is to be treated as a disallowed expenditure. To enable such sort of disallowances, a new column has been added under clause C under disallowable expenditure, and now the taxpayer can intimate the details of corpus donations in this column. Small amendments as far as scheduled capital gain is concerned in ITR 7. Up to assessment year 1920, the charitable trust could give out details in the columns exemption other than under Section 11(1)(a) or exemption under Section 112(a), which talks about the long-term capital gains on sale of listed equity shares. The Income Tax Department, it seems that they have realized that if a trust is being governed under the provisions of Section 11, 12, and 13, which are in a code itself, the ancillary exemption provisions are not applicable, and hence these reporting requirements, these reporting columns have been deleted for the assessment year 2021. Similarly, certain columns which were applicable for assessment in 1920 have been deleted in Schedule SI, which talks about income under Section 115B BPF and 115B BG, which are no longer applicable to charitable trusts. Very interesting amendment as far as the ITR V acknowledgement is concerned. Now, those who have filed the ITR forms for assessment year 2021, they would have noticed that when we upload the tax return, the general ITR V acknowledgement is not created, but this sort of receipt is being created where it states that the tax return has been uploaded, but only once you e-verify your return, the actual ITR V acknowledgement would be generated. So this is the pro forma which is generated once you upload the ITR form. On successful verification of the income tax return, the actual ITR-V is generated. That's it. Okay. And another option of pre-examined file is available on the income tax portal. Those who are not using the tax software for computing, the tax computations or filing your tax returns, very useful utility of pre-examined file option is available on the income tax portal, wherein the taxpayer is required just to download the XML file by logging in into his account, and the various incomes and the various items which are appearing in Form 26ES get automatically translated in your income tax return. A very useful utility from the income tax department. That's it as far as the changes in the ITR forms is concerned. Kinjal will just highlight us on the relevance of the efficient reporting requirements. Over to you, Kinjal.
Vishesh, just stay here. We are having one slide with the Kinjal.
Yes,
Sure.
yes, he is there. Yeah. Okay, so we felt it important to not complete our presentation without this. Relevance of efficient reporting is more and more important in today's time, when we have seen that e-governance is something which is something which is on the agenda of this particular government, wherein they are trying to bring everything in e-format or digital format, wherein we have faceless assessments, and now they are extending it to even faceless e-appeals. So as the few of the pointers which we have mentioned, just an indicative one, that why it is important right now is that firstly, as we have seen that the Prime Minister has paid extra attention on increasing the tax base, as well as the finance ministry. So they want to increase the tax base. We can see the intentions by the new 26AS forms or the new income tax return forms. Year by year, they are increasing the disclosures which are asked in the income tax return forms. And hence, we thoroughly know that this is the idea behind asking so many details. And they want to increase the tax base. Because of that reason, we will be constantly under the tax lens. Whatever is reported in the income tax return form is something which we are reporting as a true and fair statement of our tax incomes and taxes. It is just like an audit report wherein we provide fair and true information of our transactions. So this becomes all the more relevant, especially in the online version. There is linkages which have been established. The entire income tax department, we all have witnessed that in last few years have become very technology savvy. They are working on artificial intelligence and machine learning, and they have linked income tax departments with sources and resources from other departments, whether it may be SEBI departments or GST authorities or custom authorities, or for that matter MCA as well. So the kind of details which they give or they change in the form year to year, that depicts the fact that they want to interrelate and correlate and establish the linkages between the data which the assessee is providing. So one needs to be very careful while filing the income tax return form, that there is a parity between the information which is provided in the return form and the details which are provided at other authority levels also, like GST. At times, definitely it is not possible to be in sync with what we submit at other authorities, but whenever it is not possible, it is very relevant to document why it is not possible. What is the difference? Why my turnover as per GST is different, and why my turnover which I report under presumptive taxation is different? So that thought process and clarity should come at the return filing season itself, before we file the return. Now it is all the more important to report the exempt incomes and the non-mandatory details. Non-mandatory details, by that I mean those details that even if you do not file, the form will validate and the return will get verified. But so these are not the mandatory details to be furnished, like a PAN number or a date of birth. So return will go, but as Vishesh talked about that, they have this project inside which they brought about for a fortnight in the last in the last month of July, wherein they were bringing about verifications. So verifications are different from assessments, but what they were verifying is that whether the returns have been filed or not filed, why the returns have been not filed, even if you are having certain kind of transactions which are there in the mandatory list under section 139(1). If you have certain high value transactions, probably what is the source of that, and if there is no source, then why you have not even disclosed in the return form. So these are certain questions behind asking those verification details. So one needs to be very careful in reporting the exempt income also. So suppose something like a PPF interest which is exempt under section 1011, but if a person is a senior citizen and has a huge PPF deposit and a PPF interest as well, so that is a worthy income to be reported. If there is an investment made and the assessee has a huge exempt income, then in that case that will substantiate or support the investment source which has been made. So such kind of details are relevant to even avoid the verification stage, because return filing, let me tell you that is the first step towards litigation. It is the first step towards the assessments which happens, towards the verifications it happens, and we need to take corrective measures at this stage itself so that we do not land up into trouble. So that is one thing. Obviously we all know that non-filing of return or erroneous filing of return will lead to penalties. We have new sections like section 270A, which is for misreporting or underreporting of income. We have new prosecution sections for falsely misrepresenting. So all those things follow when the return filing itself is not done correctly, and at times the intention is not relevant, because now under section, it is not 271(1)(c) where mens rea was important. Now whether it is reported correctly or not reported correctly, that is relevant. So even if it is a mistake, it can it can be a heavy mistake, and it will be very difficult to substantiate that why such mistake has been made. And lastly, some do's and don'ts. Just what we thought was relevant is that first, that many return preparers use free income tax softwares online available. I think that is a complete no to file returns of income, because those do not provide complete services. So that is a complete no. I think on a lighter note, I just read some time back that someone googled whether I require help of a CA to file return, and the first answer which came is that yes, you can definitely file your return without a CA, but it is exactly same way of taking medicines without consulting a doctor. So I think that is the importance of having technical expertise before filing the return of income. Also, one very significant thing is to see is that to choose the right ITR form. Many times what happens is that we pre-validate the details and use the form of the last year itself without deciding the parameters which has been changed this year. So we may continue to use a wrong form, and it may allow us. So sometimes, so for example, under presumptive taxation, if you have capital gains, you cannot choose ITR 4. You will have to go back to ITR 3. So because you cannot report capital gain transactions there. So if you choose ITR 4, you completely miss on providing certain information which was relevant to be provided. So these are certain things which one needs to take care, especially as I mentioned, and I'll stress on it again, since everything is now faceless and income tax department is behind all those assessees who are non-filing return. So we need to be careful. And lastly, it is very important to also update and inform our clients of what are the changes which have been made, because a lot of changes have been made in disclosures also, and unless and until the client or the assessee does not provide us those details, we are unable to submit those details in the income tax return forms. So it is very necessary on our part to even inform and update them to provide us such details. So I think, yes, that's it from our side today. Thank you so much for listening to us. And me and Vishesh, we both wish you a very happy tax filing season. Thank you.
Thank you, Kinjal. Thank you very much. Can we have question? Vishesh, we can have a question answer?
Yes, Sanjay, surely.
There are questions are there in the chat box. Is
Okay.
gift from relative required to be reported as exempt income?
So actually there are two views. In fact, before this session also, I and Kinjal were discussing on this pretty issue. To my mind, a gift, if it's received from a relative itself, it is not an exempt income, it is itself a capital receipt. Had it been an exempt income, a specific provision would have been made in section 10. But there is no specific schedule, there is no specific section over there. What they have done is they have carved out it in income from other sources, making it a capital receipt. And so, hence, to my mind, it is not required to be disclosed. I think Kinjal would have a different view on
Yeah,
this.
no. I think there are people who report. So yes, we know that people who report, but technically speaking and legally speaking, it is something which is not required to be reported. Legally, I would make one point here, that exempt income schedule means the income is very much an income, but it is exempt by way of a specific provision under the Income Tax Act. Whereas gifts or which are not forming part of the income itself. So when we see section 56, these are exceptions to section 56. So that means these are exceptions to classify that as income altogether. So it actually is not an exempt income only. So if it is not an exempt income, you should not report it. But yes, as we were discussing, there are many people who still do it. So yes, there is mixed views on that.
Okay, Kinjal, thank you.
Yeah, Sanjay ji gives me a gift, I will show it income. Don't worry.
Another question is whether an SSC can opt to charge depreciation on newly acquired during September 19 to March 20 motor lorries, etc. at the rate 30% old rate instead of 45% for long-term capital gain. Can we aggregate the various transactions of particular script during the year, day, or transfer-wise reporting? It's a long question.
Okay, so the first part talks about the depreciation, correct? So
Yes.
whether the assessee could claim a lower depreciation rather than the higher depreciation. That's the question. Is that the question?
Yes, yes.
Yes. So certainly, in fact, the fourth block, which is created for 45%, it specifically states that if any motor car is purchased during this period, it is compulsorily required to be included in the fourth block itself. So to my mind, it would be difficult to claim under the lower threshold.
Okay. And the next is for long-term capital gain. Can we aggregate the various transactions of particular script during the year? Is it possible to aggregate all the transactions for the long?
So there a practical anomaly over there is if you aggregate all of them together, the FMV as on 31st January would be different for all the transactions. So in my view, it's not advisable to club all of them and in fact report them script wise, and even for one particular script, if there are 10 transactions, you are required to disclose all of them separately.
Okay. And another last question is that lot of deductors have not paid TDS. How could deductor take the TDS credit as per CPC, will process the return and create demand as it won't be visible in the 26 years?
Absolutely. I mean, this has been a problem since ages now that the deductees are not able to claim TDS credit just because the opposite person has either not filed their TDS returns or they have probably quoted the wrong pen. This issue is certainly going to continue until unless the deductee himself forces the deductor to make the the necessary changes in the TDS returns.
Send you something.
There is no other
Maybe
alternative to that.
that website pushes us to
I
the
think
Bombay police.
with the paucity of time, we have to move to next. I request our Directors Committee Chairman Paraji to give his closing remarks. Paraji? Paraji Kochar.
Hello.
Sir, unmuted. Yes, sir. Audible.
Okay. Yeah. Friends, both the learned speakers made excellent deliberation, explaining each and every change or amendment made in the Finance Bill 2019 or during COVID-19 related to income tax returns, SFT, 26AS, etc. I find no such change which has been left untouched by the young and charming lady or by the smart young man. I am sure that all the parties have been greatly benefited by the deliberation. Both the speakers touched section 43B and explained that when interest is included in loan, it will not be treated as payment and hence discounts under section 43B will be made. I appeal to the President of DTPA to bring this issue to the knowledge of the CBDT so that during this COVID-19, we expect that a lot of businessmen or the SSC will not be able to make payment of bank loan or the interest. So they will have a very hard, this is a very hard provision for them. So we should bring it to the knowledge of the CBDT to make amendment in this section, at least for this year. Regarding income tax return, I am of the view that in place of simplifying, certain returns are being more complicated year by year. And within 2 to 3 years, since the department is getting all the information through 26 AS or through the income tax return, the scope of scrutiny cases will be reduced to a great extent. Friends, I am of also view that more the transaction will be covered in SFT in coming years, because they are going to make their cross verification system very strong. And as regard prosecution, as regard our finance minister has told, and we feel that regarding non-compliance, prosecution may not be initiated. However, the prosecution will be initiated only for the tax evasion and at the last, I also appeal to the president of DTPA to give opportunity to the young speakers, young professionals who can speak, and particularly the members of the DTPA. And I'm sure that our senior professionals will also encourage them. And with these words, I over to the president.
Thank you, Parashji.
President,
Definitely will take care of your suggestions.
Narayan
May I
bhai,
request
band karo.
everyone to keep mute, please? Acha, acha. Thank you, Parashji. In the beginning, I had told that the audience will have a good number of takeaways from the seminar, and
Yeah.
both the speakers were outstanding
Outstanding
on all the issues.
Yes.
And very all the issues have been touched upon, and they've been excellent. In fact, Sanjay ji, he told me that he had heard them earlier, and he was quite sure that they'll rock. And Narayan bhai also said in the beginning, both of them are going to rock. So, considering the Mumbai residency, the right word will be rocked. Both of them rocked. So, now I request Narayan bhai. Narayan bhai, would you like to supplement?
Yeah. I would just like to take 2 minutes.
Okay.
Being,
Yes, please.
Being the chairman of the Membership Development Committee, my appeal is always for membership.
Narayan bhai, 1 minute. Narayan bhai, 1 minute. Come. Please unmute all. Mute all.
I'll just do that. I'll just do that.
Narayan bhai, please.
As chairman of the Membership Development Committee, I always take a chance of 1 minute, 2 minutes, wherever I will like a gut chance to speak to chartered accountants. Friends, we had a very superb 3 hours, almost like a Bollywood movie, without a break for samosa or popcorn or thumbs up. Both the speakers, the youth, I call them at Yuva Shakti, it rocked. So, and for those who have joined late today, again my humble appeal to all chartered accountants who have attended this meeting. As per BCAS records, we have only 150 members from Kolkata, which is a small percentage of the BCAS 9,000 plus membership. I think so, and to be corrected, that the Kolkata and the eastern region has 60,000 members put together, all the states. So I honestly appeal to all of you who are still not members to become members of BCA, come to our fold. The members of BCA gets a lot of benefits, including the prestigious journal, the BCAJ, which is 51st years of publication. BCA organizes a lot of programs, and we are on all the social medias. According to latest numbers, we have 40,000 members on social media on BCA Global, which is our name. Few of our members even tweet regularly, including some past presidents. So I would request you to please visit our website, www.bcasonline.org. For more details, application form, payment details are on the website. I appeal to all my friends and members of DTPA to become, who are members of BCA, to become our brand ambassadors and promote BCA in your city. And as far as this webinar, I'm happy that members have benefited. At one point of time, we touched 190 almost members visiting this webinar. And we are always welcome for more joint programs with DTPA. Please feel free at any point of time to reach to me or to the BCA president, any point of time. Thank you once again to the entire team of DTPA. Thank you.
Thank you, Narayanji. Thank you for the assurance. And we, in fact, we know that without your saying also it is assured. And now the virtual mode is on. So we look forward to more such meetings. Thank you very much. Thanks to both the speakers. Thanks to all. Now I request our General Secretary, Rajesh Ji Agarwal, to present a formal vote of thanks.
Good evening to everyone. On behalf of DTP and myself, I thank C.S. Suhas Sivaram Pranjape, President, BCS, and Sri Narayan Pasari Ji, past President of BCS, for giving the valuable inputs. I thank to Sri Paras Kochar Ji, our own past President and Chairman Director Subcommittee, for giving the valuable inputs. I thanks to both speakers, CA Kinjal, Bhuta, and CA Vishesh Sangoi, for giving the wonderful deliberation. I thank to all past president, office bearers, and participants for joining the webinar. I also thank to Mr. Shyam Agarwal, Chairman of Information Technology Committee, for making a nice arrangements. Thanks to all.
Thank you.
Thank you.
Thank you.